want to go to what Dana Peterson had to say over at the conference board. Confidence retreated further in April, reaching its lowest level since July 22. Consumers became less positive about the current labour market situation, more concerned about future business conditions, job availability and income. That speaks to the consumer franchises that you named.
But the weird thing about that, though, is even if there's a consumer who is not very confident, more concerned about jobs, the savings rate is somewhere around 3% right now of disposable income. I just don't understand that, John. If you are worried about the world, about your job, presumably you would save money. That's not what we're seeing. They are spending. Again, it comes to the contradictions we're seeing in the data and the anecdotes.
Let's see if we get more contradictions next week, getting you set up for a major week just around the corner. Equity futures right now going into the weekend positive by 1/3%. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Shonali Basak. Hey, Shonali.
Hey, John. The UK bounced back from a shallow recession to post the strongest quarter of growth since late 2021. GDP jumped 0.6% in the first quarter, higher than economists had expected, and the data marked the end of the mildest UK recession in almost 70 years. But it could complicate the Bank of England's rate cut path with potentially stronger growth feeding inflationary pressures. And Bloomberg News is reporting that UBS is considering introducing a reward system for investment bankers who refer clients to the firm's wealth management business. Some bankers would likely be in line for payouts when they successfully attract new money to the lender's private banking unit. And the referral fees would be a first for the Swiss lender, echoing earlier incentives that Credit Suisse had offered to its deal makers. And Apple has issued a rare apology for touting its latest iPad in a certain ad. The commercial shows musical instruments and other creative tools being crushed, drawing criticism on social media for what many are calling a depiction of the destruction of humanity. The Apple vice president of marketing communications telling Ad Age, quote, "We missed the mark with this video and we're sorry." Apple says it won't air the ad on TV as planned. And that's your Bloomberg Brief, John.
Shonali, thank you. I think we've all got stuff to say about this. Dan Ives does too. If you're apologising for the ad, I think you're apologising for the product.
Yeah.
Because that product is basically what that ad is.
It's about creative destruction, and that's literally what that... I mean, people take stuff too seriously. Apple isn't going around taking its sledgehammer to guitars. I have to say,
I watched the ad before I saw the headlines.
Right.
Didn't feel anything. Read the headlines, watched the ad. I was like, I can see it, but really?
Yeah.
And I feel like a lot of people have seen the headlines and now watched the ad.
Yeah.
And now criticise the ad.
That's true. You know, you kind of have that bias of what other people are saying.
Back to front. But if you can afford a $110 billion buyback, you can maybe direct some of that money to ad spend and avoid some of these mistakes if you believe they are mistakes. Equities right now positive by 1/3%. Dan Ives coming up a little bit later. Up next on the programme, Netanyahu vowing to fight alone.
I've known Joe Biden for many years, 40 years and more. You know, we often had our agreements, but we've had our disagreements. We've been able to overcome them. If Israel has to stand alone, we'll stand alone.
We'll catch up with Anne-Marie down in Washington. Up next on the programme, live from New York City this morning. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Live from New York City, welcome to the programme, taking you into the weekend alongside Danny Berger. I'm Jonathan Ferro. Bramo's taking a long weekend. Anne-Marie's going to be with us in Washington in just a moment. Equity futures on the S&P 500, positive by 1/3%. Yields just about unchanged on a 10-year, 444.92. Under surveillance this morning, Netanyahu vowing to fight alone.
I've known Joe Biden for many years, 40 years and more. We often had our agreements, but we've had our disagreements. We've been able to overcome them. I hope we can overcome them now, but we will do what we have to do to protect our country. If Israel has to stand alone, we'll stand alone.
So here's the latest. Israeli Prime Minister Benjamin Netanyahu vowing to continue the war in Gaza with or without U.S. support. And President Biden getting pushback on Capitol Hill. Senator Mitch McConnell saying, quote, Biden cannot have it both ways. He cannot claim his support for Israel as ironclad while denying Israel precisely the weapons they need to defend themselves. Let's head down to Washington, D.C., where Anne-Marie is joined by John Lieber of Eurasia Group. Morning, Anne-Marie.
Good morning, John. And not only is John Lieber now at Eurasia Group, but he also was a former top policy advisor for Senator Mitch McConnell, who we just heard from there. I want to first talk about the division, not just of the foreign policy hawks. We saw McConnell and Biden actually stand side by side in a lot of issues when it came to Russia, sometimes when it comes to the Middle East. But the growing division we see with Benjamin Netanyahu and this administration, how big is that gap now?
I don't think these two guys like each other all that much. That's pretty clear. There's personality differences and there's big policy differences. And even before October 7th, you had a lot of the American supporters of Israel who were not big Benjamin Netanyahu fans. And now, over the last 6 months of this bloody offensive into Gaza, Israel's become a very big political problem for President Biden, and it's starting to impact policy. And just in the last week, we've seen the Biden administration really shift quickly on its views of how supportive it is of Israel. They say that they're going to keep sending weapons and give Israel the right to defend themselves, but they're just now starting to do what the far left has wanted them to do for a while, which is condition aid, military aid going into Israel on conditions on the ground.
We heard from Senator McConnell. Lindsey Graham also yesterday was quite feisty when it comes to how this administration is conducting itself with Israel. The Wall Street Journal editorial board this morning talks about how it was the Democrats for months pushing the Republicans to sign up for more aid, and now they're the ones that don't want to send the weapons. So we have that divide between Israel and this administration. But what's the divide like in Washington between some of these Republican foreign policy hawks and the Biden administration?
Yeah, I think the interesting divide isn't the Republicans and the Democrats here. I mean, the Republicans clearly benefit from criticizing Biden at every opportunity they can. They clearly want to align as much as possible with Israel and be the pro-Israel party. What's more interesting to me is you've got senators like John Tester from Montana, Democrat running for a re-election in a race he's probably going to lose, saying that he does not support what the Biden administration is doing and declaring his ongoing support for Israel against the wishes of the Biden administration. So that divide is a really big one, and it's not just across party lines.
This comes as they're trying to really walk this fine line because of the pushback they're getting from the progressive left and also the protests on the ground, and also the fact that they are concerned about this densely populated area in Rafah and what these type of bombs would do potentially to civilian casualties. When you lay that all out, though, what does this mean in terms of their off-ramp? Because Bill Burns already left Cairo. There's no hostage negotiation. How do they have an off-ramp, this administration, from this crisis?
The administration doesn't. The only off-ramp here, and the Israelis have been really clear about this, is that they need to succeed in Gaza. They need to achieve their military ends, and they need to rout out Hamas. Now, that's not going to be easy, and an operation in Rafah won't be the end of that, because even after they do whatever they think they need to do in Rafah, they're going to going to probably have to be fighting an insurgency in Gaza for the foreseeable future. And there still looks like there's no plan in place for how to govern the area once the military has withdrawn, which means that Israel is going to be involved in this conflict for a long time, potentially years to come. And that means the Americans are going to have to make this choice about how much aid they're willing to supply and what weapons they want to give the Israelis to fight this war.
Given this is going to go on for months and, as you say, potentially years, what does this mean for this administration in terms of policy heading into the election? How much tougher do you think they'll get in terms of rhetoric and action on Israel?
So just today, we heard about this report that could be released from the administration criticizing the Israelis for human rights violations in Gaza. That would itself would be a big rhetorical step up, which on top of the threat to withhold weapons suggests that there's an accelerating split between the White House and Netanyahu, which is the Israelis are signaling is not a problem for them. They're going to continue to fight this offensive, but it is a big problem for Joe Biden, who has this massive split within the Democratic Party, has been acting somewhat indecisively on the issue, saying he really supports Israel all the way to the end, and then now pivoting a little bit to maybe say, no, there's limits to our levels of support. That's a huge political vulnerability, and he's going to be on his back foot for the remainder of the 6 months of this presidential campaign he's got to fight.
That's what Axios is talking about this morning. Some of these big donors within the Democratic Party saying to the administration, you say you're ironclad, but we feel like there has been a shift in terms of your policy on Israel. We also have a Bloomberg scoop overnight that this administration next week is planning on finally coming out with, they've been signposting now for months, higher tariffs on Chinese EVs. What else can we see them pull, levers they can pull before the election?
Yeah, I think this EV story is actually a pretty big one. I mean, if you look at the two of the big battleground states, is Michigan and Wisconsin, which are traditional hubs of the auto industry, heavily unionized auto workforces there. And Donald Trump has been pretty explicit that on the attack that Joe Biden's electric vehicle subsidies and the IRA are hurting these auto workers. So Biden, by putting out this 301 investigation, gets his chance to say, no, I don't like China in this country. I don't like all this Chinese competition. And I'm going to make sure that all the electric vehicles are made here in the United States. There's a lot of programs like this. You got student loan forgiveness is a huge, huge theme of the administration leading up to the campaign. But this EV is going to be a big vulnerability for them.
When it comes to the EVs, do you think it's the economics, the fact that even the Europeans are also complaining about all these cheap Chinese products are being dumped on their markets, or do you think it's politics? The Trump campaign is almost forcing their hand.
Well, Gina Raimondo called these Chinese electric vehicles iPhones on wheels. And basically, the idea is that they have so much information they're gathering about everyday Americans who drive around in these cars that the U.S., like we've seen with TikTok, does not want that type of information getting in the hands of the Chinese Communist Party. So I think there's both an element of politics and policy here. And right now, the Chinese EV share in the United States is basically non-existent, and I would be shocked if either administration allowed that share to grow at all. So,
well, that's the other question. Why do they need higher tariffs? It's already 27.5%.
Yeah, it's not the EVs themselves that are the big problem for the U.S. right now. It's the components. And one of the big geopolitical concerns as the U.S. is trying to push a green energy transition is that China ends up dominating the green energy supply chain, whether that's batteries or critical minerals or solar panels or whatever the components are that the U.S. right now is deeply subsidizing through this very aggressive industrial policy. Their goal is to make sure that this is not only an industrial policy, it's a reinvestment in America. They want that money to stay here, and they don't want any of that money going to China.
John Lieber, thank you so much for your time this morning. John, of course, that was John Lieber of the Eurasia Group and former policy advisor to Mitch McConnell. And you heard it there. I mean, these stories are going to continue until the election. When it comes to the EVs, potentially we'll finally get those details next week.
We expected this, didn't we? AMH, don't go anywhere. We need to talk more about it. If you just caught the tail end of that conversation, exclusive reporting from our colleagues here at Bloomberg, Josh Wingrove, Jennifer Jacobs, Eric Martin. According to people familiar with the matter, President Joe Biden's administration is poised to unveil a sweeping decision on China tariffs as soon as next week. We've been waiting for this one, Danny, for weeks, if not months now.
Yeah, we have, because in the build-up to to the campaign. It does two things. One, it's the rhetoric of who's stronger in China, Biden or Trump. And then also it's something that the United Auto Workers have been complaining about. So this also goes to Biden's union vote, too.
What does this mean for Tesla? We'll catch up with Dan Ives of Wedbush in just a moment. He'll join us after the commercial break. We'll talk about Tesla, EVs out of China, the competition there, and we'll have a conversation about Apple, the Apple iPad, and a commercial. Was it really that bad? We'll get the official review from Dan Ives himself in just a moment. Equity futures on the S&P 500 positive by 1/3%. It yields just about unchanged going into the weekend. 444.92 from New York. This is Bloomberg.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how 1/3 of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Heading towards 3 weeks of gains on the S&P 500. Check out the NASDAQ positive again by 0.4%, on the Russell up by 0.5%. If you take the sector breakdown, Danny, I'm so pleased you brought this up. Utilities, what is it about?
I've heard someone say, oh, it's an AI play. I mean, come on. Everything these days is an AI play. But yeah, up nearly 8% this month.
Amazing. All roads seem to lead to the same theme, even when maybe they shouldn't. Switch on the board and get to the bond market. Yields lower once again for a second week on a 10-year to 444.92. We're down not even a basis point this morning. But check out the 2-year. Let me go through some levels for you. The 2-year last Friday closing at 481.60 and right now 481.29. We have been pretty anchored at the front end, Danny Berger, given we've got pretty much no data this week apart from jobless claims and UMich, going into a heavy data slate next week.
Yeah, how anchored are we next week? We've also seen bond auctions come through, $125 billion this week. Sure, 10-year a little bit weaker, but for the most part, the market absorbed it. But at what point does it not hurt the front end, but of course, duration, the longer end? At what point do you need more return in order to actually buy those bonds?
And that's where the flexibility in the yield curve has been over the last week or so. It's all at the long end. I want to talk about foreign exchange, just how much movement we've seen in dollar yen. So last week, dollar yen had its biggest week against the dollar, going all the way back to, I think, December 2022. We had a 3% move in the yen's favour. On the same week, we also broke through 160, which is just bonkers. This week, we've had another 1.74% move, but against the Japanese yen, dollar yen at 155.73. And Danny, as you've said repeatedly, it doesn't matter what Japanese authorities say this week, the yen is moving against them.
Theoretically, this should be the week where job owning works, right? Because we didn't have any U.S. data that would really strengthen the dollar. This should be when Japanese officials, and even Ueda himself, coming out and saying, okay, we'd look at changing monetary policy if they're one-way moves. But again, it's a credibility issue. The traders are not buying it until perhaps they see the white of the eyes of a hike from the BOJ.
155.74 on that currency pair. Under surveillance this morning, our top stories. Israeli Prime Minister Benjamin Netanyahu vowing to continue the war in Gaza with or without U.S. support. Netanyahu saying in a U.S. television interview, if we have to stand alone, we'll stand alone. The comments coming after President Biden threatened to withhold U.S. weapons if Israel continues with a ground invasion into Rafah. Our next story, another investigation into Boeing. The SEC is said to be scrutinizing statements the company made about its safety practices before and after the door panel blowout on an Alaska Airlines flight in early January. If the agency finds the company or its executives made false or misleading statements, it could lead to fines. We're down by 0.2%. Every single week, there seems to be another negative story about this company.
The thing that I can't get over is that now we have the SEC looking into Boeing, and we still don't know who's going to replace David Calhoun. We still don't have a new CEO who's going to come in. That should be job number one. If you want to alleviate some of the concerns of investors, perhaps even regulators, if they're now looking at executives specifically, surely this is what you would do, and we are still not there.
Keep hearing 1-800 Larry Culp again and again and again, and we'll see. Let's turn to this story. President Biden set to impose new tariffs aimed at strategic sectors, including China EVs. Bloomberg reporting the measures come after a review of tariffs imposed by the Trump administration. People familiar with the matter saying a decision could come as early as next week. Anne-Marie joining us now from Washington, D.C. for more. AMH, we've been waiting for this. You've been waiting for this. We thought maybe it would come later this summer, closer to the election. Could we hear from them next week?
Potentially, what we're reporting here at Bloomberg overnight in this Bloomberg Scoop led by Josh Wingrove, one of our reporters on the ground, John, is that it can come as soon as Tuesday. And this would go into some strategic areas the administration has talked about when it comes to this competition with China and the concerns also of national security. And most notably, it's the EV sector. But remember, around this time last month, we spoke, you and I, to Catherine Tai, the U.S. trade representative. And she said, quote, they were coming soon. The issue, of course, Jonathan, has been the fact that the trade rep has been going over these tariffs from the Trump administration that were enacted in 2018 since 2020. So what we heard from John Lieber there is that he feels like the administration has been on the back foot. Why did it take so long? But we do know that it's potentially coming next week. They've gone to great lengths, this administration, to signpost it, but we're still waiting to hear on exactly what these details are. Remember, it's hard to buy a China EV in the United States now. You can't. They don't sell here. And the tariff right now is north of 27%.
So is the symbolism enough then, Anne-Marie? Is it enough to convince voters that Biden is the choice if you're a China hawk?
Well, that's on the political side. And John Lieber really feels like part of that is that the Trump administration pushed Biden into this. I think one thing is for certain when we get the details of this and you see the direction of travel of this administration, whether it's export controls, whether it's more tariffs on China goods coming into the United States, most notably EVs and some of the components that go into them, It is clear to China and the rest of the world that whether or not we get Trump or Biden in the White House next year, you're going to get a very similar policy direction when it comes from what Washington is doing and their concerns for Beijing. And by the way, we've heard from Beijing, and this is one of the quotes I'd like to bring you. Quote, instead of correcting its wrong practices, the U.S. continues to politicize economic and trade issues. To further increase tariffs is to add insult to injury. So that's the response overnight from Beijing.
AMH, stay close. We'll catch up with Anne-Marie in the next hour, and much more on this story as well. The reporter behind the story, Josh Wingrove, joining us in about 1 hour and 10 minutes' time. With us around the table, Dan Ives, who covers Tesla and General Motors for Wedbush. Dan, good morning to you.
Great to be here.
If the barriers go up, if the wall gets a little bit higher for Chinese players, do the Chinese do the same thing to U.S. players?
That's the worry, right? I mean, the retaliatory is the last thing that you need from a Tesla perspective. And I think this is something everyone's been waiting for, because the reality is, given the prices of the Chinese EVs and what I've seen firsthand, it will be very tough from a competition perspective. Retaliatory definitely could happen. This Game of Thrones continues to play out.
You mentioned a product. Can we talk about that a little bit more? I don't think enough is said about that. I think a lot of people often consider Chinese products to be cheap imitations of maybe US innovation. Are you seeing that out of China? How good is the product?
I mean, BYD is special. I mean, and I think I think from a competition perspective, Tesla's seen that in China. I still view it as there's going to be many winners there. But when you look at BYD, you look at NIO and others, that comes to the U.S. That's a major competitive issue, especially when it comes to Detroit. The 313 area, has bet so much on EVs, so that you're really protecting that for Detroit as well as ultimately even for Tesla domestically.
BYD gave an interview to the FT yesterday where they basically said by 2030, we're going to be the biggest EV car maker in Europe. No one else is going to be able to hold a candle to us. Is Europe next? Is that the next risk for the Chinese EV sector?
Yeah, Europe's front and center. I think that's going to be the battleground. And look, and that's something not just for Tesla, for a lot of the German automakers and others, and Beijing has their sights there. And I think what we're seeing here is, even though EVs is moderated globally, and of course that's been a black eye for the industry, it's still the massive transformation, probably the biggest one we've seen since 1950s, and that really, I think Europe's going to be the next battleground.
I would say that black eye for the industry, it hit Tesla really hard, and their saving grace was that they went to China, that Musk met with Xi, and he got these measures that seem to indicate autopilot can exist in China. So if that's taken away, what happens to Tesla? What happens to share prices and our confidence in them?
Look, and that's why Musk, 10% politician, 9% CEO. We see the same thing with Cook. China's the hearts and lungs of the Tesla growth story. When I look at FSD autonomous, I think the first step now toward what could be, I think ultimately a golden vision now from an autonomous perspective. But China is the hearts and lungs of the growth story, and that's well known. It's been a headwind, but we do believe that you'll start to see a tailwind in the next coming quarters.
It's funny you would refer to, perhaps even allude to, Elon Musk being somewhat of a diplomat, because a lot of people in America wouldn't share that perspective whatsoever. How much distance is he able to put between the view of his government and his personal views in the face of Chinese authorities?
It's a balancing act, right? But how many CEOs could fly over to Beijing and 10 hours later come back?
Very few.
And look, and I think it just speaks to that power of Musk, despite the controversy. China, him and Cook, have been able to navigate China better than any two CEOs. And that's why for Apple and, of course, for Tesla, China is a key growth engine. That's not changing anytime soon.
Let's talk about the power of the iPad and the power of Apple. Let's get this commercial up. Can play it in the background as we have this conversation. What on earth happened with this Apple commercial around the iPad?
I mean, look, obviously an apology from Apple is rare. But if you look at what they're doing here, Apple's doing what Apple does.
What are they apologizing for?
They're basically apologizing for, it's essentially showing that traditional music, traditional arcade, things that we've seen from 80s, 90s, they're basically consolidating that into the iPad. So it's viewed as maybe a shot across the bow. But look, Apple's doing what Apple does, and I think they definitely, had some controversy from this. But It's unusual for them to have to apologize.
Are they apologising for the product, basically? Given what you've just said, haven't you just described the product?
That is the product.
So what are they apologising for?
Look, again, I don't know. I mean, it's like Brunson apologizing for throwing up 40 on a night.
Right? Doesn't make sense.
Doesn't make sense.
Also, isn't this completely contradictory to the whole thing about Apple? The whole, oh, we don't give the consumer what they want. We tell them what they want. What are they doing apologizing?
Look, and I think right now, given the scrutiny they're getting from Brussels, from D.C., from everywhere else, they need to sort of walk the line. But look, this goes into what is going to be potentially the biggest event they've had in a decade, going into WWDC next month, where they're going to unveil AI, not just to their customers, to developers, but to the world.
I mean, what do they need to show to really get us excited about the iPad besides, you know, a little smiley face toy being exploded? Because, I mean, I've had the same iPad probably since 2012. Nothing motivates me to get a new one. So what do they need to show up with to say, all right, an iPad cycle, it's coming?
It's about the chip. I mean, if you look, they have the most powerful chips in the world. And what they're able to do is these upgrade cycles. When you look at iPad, this is going to create an upgrade cycle, but it's happening across the whole base because iPhone 16 combined with hardware, they essentially have an AI-driven super cycle that's now going to take place over the next few years. And that's why betting against Cook and Cupertino into an AI upgrade cycle, I personally believe is a bad bet.
You've been talking about this elusive upgrade cycle for quite a while. You're smiling, I am too. We've had this conversation for a few years. It never happened. What is different about this year? And is the iPad maybe a case study for what we could see from the iPhone later on in September?
I think it's a little case study. But the big thing is really going to be AI to developers to the App Store. On the services side, they're going to monetize it from a services perspective, but then you're going to have AI built into iPhone 16 and what will ultimately be iPhone 17. The difference, and we've talked about that upgrade cycle,
sure,
but 270 million have an upgrade in 4+ years. That install base, as we've talked about a lot on the show, has continued to increase. And even though it's been disappointing, we could say, into iPhone 15, that just ultimately gives, I think, music to the ears of the bulls going to iPhone 16 because of the technology and because what I view is AI is going to drive
I'm one of those. I'm one of those individuals. If you aggressively upgrade the functionality of this phone, I'll consider changing it. But over the last few years, there's been absolutely no reason for me to do that whatsoever. I want you to help me understand this developers conference, what we're going to hear specifically without using the letters AI,
sure, what
they're going to do, what these apps are going to look like that could be on this phone come September.
Well, I think the most important thing is this is the start of an AI app store. And what that basically means is developers, they're going to build generative AI apps. Where are they going to build it? They're going to build it within Apple's ecosystem. They're going to be able to monetize. And from a technology perspective, you're going to see, I think what they're going to unveil at WWDC is going to be a historical moment for Cupertino and Cook. And that's why betting against Apple here,
okay,
and I believe the risk-reward is potentially golden buying opportunity as we look out the next 6-12 months.
I think you said it twice, but we'll let it go. Dan, it's good to see you.
Sure.
Dan Ives of Wedbush, thank you, buddy. What a week for New York sports. Just fantastic. Knicks, Rangers.
1994 all over again. That's why, look, betting against Apple is like betting against Rangers and Knicks.
Okay. You think the Knicks get it done this year?
Oh, I think this is the year.
Interesting. Did you make it to the Grand Prix over the weekend in Miami?
I did not make it to the Grand Prix, but I watched the Grand Prix.
Okay.
And,
you're dressed for it, Dan. You could have come straight from Miami.
Look, I'm just following Farrow's lead on F1. I wasn't an F1.
I know.
I wasn't an F1 fan. Farrow combined with the Netflix, now I'm in.
We'll talk more about it in just a moment. Dan, it's good to see you. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Shonali Basak. Hey, Shonali.
Hey, John. TSMC sales jumping 60% in April. The world's largest contract chip maker reporting sales of $7.3 billion last month on the back of sustained demand for AI, aided by a recovery in consumer electronics. The jump follows a 34% sales increase in March, with shares of the stock rising to an all-time high in April. And Target won't sell LGBTQ-themed merchandise in some of its stores during Pride Month after a backlash dented revenue last year. The Minneapolis-based retailer plans to offer the full assortment online, according to people familiar with the matter. And Target faced threats from some customers last year over its Pride merchandise in the month of June. And campus protesters at Harvard University say they will stay in their tents and continue an encampment in Harvard Yard. The school newspaper reporting that the Harvard Out of Occupied Palestine group has rejected a proposal from the interim university president, Alan Garber, to leave the yard and avoid punishment up to and including suspension. The group posting on Instagram that Garber has rejected their counteroffer that would, quote, move Harvard forward on transparency and ethical investment. And John, that's your Bloomberg Brief.
Hey, Shonali, thank you. We'll hear from Shonali again in about 30 minutes. I knew where this conversation would go. Lobster rolls. $280. Was it actually for one lobster roll in Miami at the Grand Prix?
I think that's actually two.
It's two. You get two.
It's two.
Seriously.
Thank God.
Yeah, exactly. I mean, like, look, they have to be some real good lobster rolls. You combine that with some rosé.
I'm sorry, that is absolutely ridiculous. Dan, it's good to see you, buddy, once again. Thank you, sir. Up next on the program, a busy week of data on deck.
You are seeing that impact of higher rates finally begin to filter through. I think we just need to see more data, particularly this CPI print next week, to get a better sense of it.
CPI data coming up next Wednesday from New York City. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
On the S&P 500, equity futures positive by 0.33%. In the bond market, yields just about unchanged, 4.45.31. Under surveillance this morning, a busy week of data on deck.
One of the things that gives the Fed a bit of confidence that, they are applying the brake in the right way is you are seeing that impact of higher rates finally begin to filter through. We're still in the early innings of seeing the data really cool, and last week had some for the bulls and some for the bears. And so I think we just need to see more data, particularly this CPI print next week, to get a better sense of it.
Something for everyone. Here's the latest. Traders looking ahead to a busy lineup of data next week. PPI, retail sales, and the latest CPI print all on deck. Lindsay Piegza of Stifel writing this. It's reasonable to wonder whether or not the Fed is at all considering the scenario whereby inflation fails to improve or worse, continues to rise in a meaningful and persistent manner. Lindsay joins us now for more. Lindsay, let's get ahead to next week. What are you looking for from CPI?
I think we continue to see very frustratingly, stubbornly high levels of inflation. Price pressures in terms of the consumer still moving around 3.5%, 3.6%. with producer prices continuing to move further above that 2% threshold. So the Fed and investors alike are looking for meaningful reprieve in inflation, but unfortunately, I think they're going to have to continue to wait for some time longer.
Lindsay, can you build on that? Could you sort of break up and divide what's happening with goods prices and what's happening with services prices and how different those trends have been over the last few months?
Well, services is really where we've seen the vast majority of the pressure, with labor costs obviously the largest component on the service side continuing to elevate this persistent and rising trend. Goods inflation, excuse me, still remains the most beneficial component of the inflationary story. But with international risks, I think still to the upside, goods disinflation or outright deflation may begin to soften that contribution to the improvement that we've seen. And in fact, if you think about it, the vast majority of the gains that we've seen in the inflation picture have come from variables outside of the Fed's purview. Economies coming back online, trade lines reopening. So should we see some of that improvement reverse course, I think we could exacerbate some of this elevated inflationary pressures that we've been seeing since the start of the year.
Lindsay, one of the arguments of CPI coming in softer next week, this is something that Ellen Zettner and her team over at Morgan Stanley make, is that rental inflation is going to be coming down, that finally the lag that we've so long been calling is going to catch up, and that's going to help CPI. Does that argument miss something?
Well, I think the timing might be off. We've been talking about this reprieve coming from shelter costs for the better part of the past 2 years, which has failed to materialize. As we continue to see housing demand outpace housing supply, I do expect the shelter costs to still remain quite robust for the foreseeable future, as we do expect the Fed to keep rates at these elevated levels. Now, there have been some pockets of reprieve in terms of rental prices, but we've also seen a lot of these repricing, so existing leases coming back online at 30, 40, 50% resets in some of these more concentrated areas. So I'm not yet convinced that we are seeing broader-based reprieve or broader-based lessening of pressure in terms of shelter costs, at least not yet.
And Lindsay, this gets back to what John started on, what you said, this idea, is Powell considering the scenario where inflation doesn't moderate, but instead it gets worse. Lindsay, he doesn't sound like a chair that is considering it. All of the Fed speakers we've heard, same thing. They're still talking about cuts, even though they don't know when it will be. Should Fed speakers and should Jay Powell be reintroducing the idea of two-way risk?
Well, when you look at the takeaways from last week's FOMC meeting, I think there were two. First, the chairman conceded that it's likely to take much, much longer for the committee to gain confidence that inflation is back on this disinflationary trend. But that being said, even with that realization, the chairman was very clear that the committee's next move is likely still a rate cut and not a rate hike. So even though the committee is committed to remaining on the sideline for, again, an extended period beyond earlier expectations, they're still very much focused on eventual policy easing. And I do think that as inflation remains at these elevated levels or even pushes slightly higher, I think that still justifies the Fed's position in a steady state. But what happens if inflation continues to reverse course? At what point is the Fed not just willing to delay rate cuts, but actually talk about re-engaging in rate hikes? And I think that's the riskiest scenario for the economy, and that comes with persistent and elevated inflation. And to quantify that, I think maybe 6, maybe more months of this continuing upward trend, that's going to force the Fed into a corner and force the Fed to re-engage, or at least consider re-engaging in rate hikes. But again, to your point, right now the Fed is entirely focused on eventual easing, which they've said will be delayed relative to the earlier timeline, but that eventual easing is on the near term, or in their expectations for the near to medium term.
These are clear and obvious risks. What's your base case now with those in mind?
My base case is that inflation remains stubbornly elevated, well above the Fed's 2% target through the end of the year, keeping the Fed then potentially on hold through the entirety of 2024. Remember, the Fed has a very clear dual mandate. full employment, stable prices. The Fed is very clearly able to check the box on full employment. So the focus is entirely on stable prices. Powell has been very clear that 2% remains the target. It has always been the target, and they are willing to remain on the sidelines indefinitely until they're convinced we're getting back to 2%. But that timeline on the sidelines now appears to be extended well beyond expectations.
If there are upside risks for prices and inflation, could you tell us how much there is downside risk to the labour market, given some of the data we've seen recently?
Well, it does appear that the labor market is remaining surprisingly resilient. Now, in terms of the latest data, the headline number was somewhat disappointing relative to those outsized gains that we had seen at the start of the year. But still, the latest report at 175, even at a 6-month low, is still nominally a robust level of job creation on a monthly basis. And even that minimal uptick to 3.9% still marks the longest stretch of below 4% joblessness since the 1960s. So we're far from talking about a loose labor market. Labor conditions may not be quite as tight as they were, but we're still talking about a very resilient, still relatively tight labor market in the U.S.
Lindsay, this was great. Lindsay Piegza there of Stifel going into that data next week. CPI and retail sales coming on the same day, May 15th. Amazing how many people have joined the camp over at Apollo, together with Torsten Slog. Not just Lindsay, also Stephen Gallagher over at SocGen saying this: we expect the Fed to keep policy on hold for the remainder of the year. The upcoming CPI is the next major economic release, but it should take many more months for the Fed to gain sufficient confidence that inflation can return back to 2%. We'll get more thoughts on that story in just a moment. We'll catch up with Jim Bianco of Bianco Research alongside Anastasia Amoroso of iCapital, Norman Rule of CSIS down in Washington with Bloomberg's Anne-Marie, and Bloomberg's Josh Wingrove on the latest story out of D.C., the prospect of tariffs on China's EVs. Equity futures on the S&P 500 positive here by 0.33%, the second hour of Bloomberg surveillance. Up next.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
looking for a shock and awe, if you will, in inflation, but we do think the gradual incremental increase is a risk.
Inflation remains public enemy number one. And what I think would lead the Fed to become more hawkish is if we saw that re-acceleration in inflation.
We know this is a bumpy ride for inflation, but they will also need further evidence in the data.
As we do see the Fed reacting to a slower growth trajectory and or a moderation in inflationary pressures by some toleration of easier policy.
This next phase of the inflation fight, it is going to require more pain and I think a bigger hit to demand.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance, your equity market on the S&P 500, positive on the week for a third consecutive week and positive on the session. Equity futures up by 1/3%. A stacked 60 minutes for you. Coming up on the program, Jim Bianco of Bianco Research on why the 10-year yield could test 5%. We'll speak to iCapital's Anastasia Amoroso with stocks on course for 3 weeks of gains, and Norman Rule of CSIS as Benjamin Netanyahu strikes a defiant tone. We begin with our top story. Treasury yields holding steady with a slew of Fed speak on deck. Jim Bianco of Bianco Research moving to neutral on bonds and writing this: I expect a 10-year yield move to 5 to 550 to produce extreme sentiment and set up a decent bond rally. Jim is with us around a table for the next 60 minutes or so. Jim, good morning to you.
Good morning to you.
You had phrase, I think, of the last 12 months, that disinflation is transitory. Could you just tell us what was behind that call and where we are now?
Well, yeah, I think, the two things can be true at the same time. That in 21, 22, you did have this transitory part of inflation with the supply chains normalizing, and on CPI that produced 9%. Then it came down. But I think once we got rid of that transitory inflation, what we're finding is that we're probably stuck in a 3% inflation world. So we're not going back to where we were pre-pandemic. We are in a higher nominal growth world. We are in a higher inflation world. But again, it's a 3% inflation world, which means elevated interest rates, but nothing like Zimbabwe or anything like that.
Well, let's talk about the elevated level of rates that we should be used to. Nothing like Zimbabwe. Yeah. What should it be like?
Well, I think that what we're looking at with a 450 yield right now is probably pretty close to, I'm talking about on the 10-year yield, something normal. This is about normal-ish. Anything lower than that would probably come about with weakness in the economy. And if the economy was to show more signs of inflation or strength, you could probably see us push back into the 5 handle again.
We've got to talk about what this means for the bond market more broadly as well. You've got a piece in the FT out this morning. The headline is, the total return strategy in bonds is far from dead. What prompted this particular one?
Bill Gross wrote a piece last week, and he said that total return strategy is dead. And I took issue with it to say that a certain style of total return strategy is dead.
Just explain that.
Yeah, so in the bond market, Bill Gross, PIMCO, they really developed the idea of total return. You buy bonds to get a coupon, a yield, and then you also have price appreciation. The two of them is total return. For the last 40 years, the total return strategy has been driven by lower interest rates and ever higher prices. Well, that era probably ended in 2020. But that doesn't mean that bonds as an investable class or a total return is done. There's a big yield in the bond market now, a 5% yield. You could start off every year saying, I can get a 5% yield, and if you manage around that properly, you could maybe do a little bit better than that, or a little bit worse if you don't. But I think there is strategies in the bond market that can still be very profitable.
Jim, it's not even total return that folks have declared are over. There are a lot of strategies out there that, if you're right, if interest rates are settling at a higher level, perhaps seem like they don't work. M&A is a great example of private equity just waiting in the wings for there to be cuts, for rates to go back below to where they are. So what doesn't work? Total return works, what doesn't?
Well, I think any strategy that was reliant upon lower interest rates, you're right, a lot of the levered M&A strategies that were really the foundation of those strategies was near zero interest rates. Those are going to be very difficult. You're going to have to look at your interest cost relative to the business you're buying and the cash flows that it throws off. And that's going to make the hurdle rates for a lot of these purchases or a lot of these acquisitions a lot more difficult. I don't think we're going to be going back to those microscopically low rates that we saw from 2008 to 2020. That was a unique era that even got us to negative interest rates in Europe and Japan. that probably isn't going to be repeated anytime soon.
What happens to the deals that have already been done, that have had a lot of leverage on them, that refinance when rates are low? What happens to them if rates don't go back down?
They struggle. They struggle because the companies won't be able to throw off enough of a cash flow to actually meet those debt service costs. And it's going to be a difficult period for them.
Jim, let's build on that. What's the timeline for you around that? The phrase we hear a lot on this program is survive until 25. When do you start to see that pressure start to build?
I think it probably starts to build sooner rather than later. I think when you look at the economy, I like to say that every time there is a financial crisis or recession, and we had both in 2020, the economy changes. And this one did change. Now, change does not mean worse. Change means different. And the biggest thing that came out of this is you've seen lower personal savings rates. You've seen higher levels of spending. It seems like people, for lack of a better term, they got PTSD after the lockdown, and then we had revenge travel, and that never stopped.
Still going.
We still have it. We still have people spending. We have the government spending, 6% deficit to GDP, and that's going to continue to push this economy forward, and it's going to continue to keep it running hot. Now, that's good. That's going to keep the unemployment rate, which has been below 4% for 27 months, probably down at those levels, but the price of that is going to be elevated inflation.
The credit stress, though, that you mentioned, can we just sit on that for a while longer? Just a couple of beats. How ring-fenced is that going to be? And let's go back 12 months to last spring. Get some regional banks starting to fail. People are thinking it's the end of the cycle, hard landing. It was dealt with. We've moved on from that. How ring-fenced are these pockets of credit stress going to be?
I think that they are going to be. The regional banks is a good example of that. They really struggled in the face of higher interest rates with the case of Silicon Valley, but then also the realization that came in last year that office real estate is not going to bounce back as much as everybody thought. And that's why the regional banks and a lot of the smaller banks got hit. And it was ring-fenced to the extent that if you look at their stock prices and if you look at the stress that that sector went under, it never really translated to like the general economy or GDP or retail sales or anything. So you've seen these pockets keep coming through as we've tried to adjust to this world of higher interest rates.
So to be clear, you don't see any of those pockets necessarily filtering through to the broader economy if there is that stress?
No, I don't at this point. There's an economist, Rudy Dornbush, who used to work a lot with the Fed, and he had a famous line that expansions don't die of old age, they're usually murdered. And we don't have, now the murder weapon historically has been a spike in oil prices, geopolitical events, or suffocating interest rates. And I don't think 5% is anywhere near suffocating interest rates. We don't have that. And short of that, I think that the general economy will continue to do okay, if not better than okay. Now, I'm always on the lookout, like everybody else is, about that murder weapon that could come. I thought maybe a year ago it might have been the banks, but it turned out not to be the banks.
Well, and you mentioned you have the two big spenders still out there. You have the government and you have everyday consumers. The government doesn't seem like it's going to stop, regardless of who's in the White House. When it comes to the consumer, you mentioned that low savings rate, something around 3%, they're still spending. Is this the forever now? Is that PTSD just enduring from time on out here?
This cycle, the spending, I hear a lot of people talk about that the consumer is going to slow. Well, they'll ebb and flow. But what the consumer will do is they will keep spending this cycle. What I mean by this cycle, we get that murder, we have a recession, then attitudes change again. Maybe they change that the savings rate goes to 0. Maybe it changes the savings rate goes to 5%. But for this whole cycle, I think that that's not going to change.
Lisa's not here, and this conversation's getting dark very quickly. Let's just talk a little bit more about benchmarking to extremes. You almost corrected yourself when you talked about inflation. You said it's not Zimbabwe.
Right.
And when the word stagflation comes up, people often come out and say, well, it's not the 1970s. And we heard that from Chairman Powell last Wednesday. Do you think stagflation is as much a laughing matter as maybe as it was to the chairman last week?
Well, you're right about, benchmarking yourself, because a lot of these terms, when you talk about inflation or stagflation, everybody goes to the extreme. If you say that there's going to be inflation, they think hyperinflation or something. And they're not ready to think about the idea of it being, somewhat elevated. As far as stagflation goes, yeah, if the definition of stagflation is elevated inflation in an era of slower growth, yeah, that's very possible. But if you want a definition of stagflation of 5, 6, 7% inflation with contracting growth, that's an extreme definition that I don't think we need to go to just yet.
It's the weaker growth that I want to get my hands around. Danny's done great at this over the last couple of days, just going through some of the consumer-facing companies that are facing difficulties, others that aren't at all. Then we get the economic data over the last week, and it's actually pretty easy to construct maybe a decent story of how bad things are right now, even though you might make the argument they're not at all. This came from Andrew Homlust. I shared this quote a little bit earlier on the programme. I think it's worth going over again. Companies are conserving on labour costs by slowing hiring, they're cutting working hours, small business hiring intentions have dropped, multi-year lows, individuals are becoming more concerned about finding a new job and are quitting at lower rates. Have you got a counterpoint to any of that?
No, all of that's true. The only counterpoint I would give, let me take the last one, that they're quitting at lower rates. It's still, the quit rate is higher than anything we saw before 2020. And a lot of these numbers that we're looking at, we're saying, yeah, they have slowed from that red hot pace that we had in the middle of 23 when we were almost 5% GDP. But if you compared it to, say, a pre-2020 era, these numbers are, I want to say completely different, but they're in a different level than we saw before. This economy is at a different pace. So yeah, the economy is ebbing, but I don't, you know, and it was flowing big last year. But I don't necessarily think that this ebb is going to lead to anything more than just a downturn within an economy that continues to grow at least a trend.
OK, well, let's put a bow on it and get the policy calls. So Torsten Slok Apollo, no cuts this year. SocGen, no cuts this year. Lindsay Piegza of Stifel on with us just about 10 minutes ago saying basically no cuts this year. Where are you?
I'm at the same point. You basically no cuts. I'll give you two reasons for it. One, I do believe the Fed is political. I do believe that they've noticed the schedule that June, July, and September is the middle of a presidential election. They'll move if the data warrants it, meaning that there needs to be a shock in much weaker data. And otherwise, we're looking at November or December, and only if the data does weaken enough, because Powell said, I need confidence, and I don't have it. Well, we're waiting for that data to show up.
You've got to drop that in and not move on. We're going to sit on this for a while longer. They are political. Politically biased or politically sensitive? There is a difference.
Right. Claudia Sahm, the economist, gave me a great term. She said that they're not partisan, but they are political. Partisan. They don't sit around the FOMC table figuring out which candidate they want elected. They do not do that. Do not consider that. Political, they've noticed the calendar. They've noticed the wins in Washington. They've noticed where their reputation is. And so that's what I mean by political. They've noticed that the July 31st meeting is right in the middle of the Republican and Democrat convention, to give you one example. That's what I mean by political.
Got it. Jim, you're going to stick with us through the next 45 minutes or so. Jim Bianco there of Bianco Research. Equity futures right now on the S&P, positive 1/3%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Shanali Basak. Hey, Shanali.
Hey, John. Sony plans to sell off the historic Paramount Pictures lot in Hollywood if it purchases the company, and that's according to people familiar with the matter. Sony, which already owns a large film and TV production facility, is said to only be interested in Paramount for its IPs, like the Godfather trilogy and the Top Gun films. In a report from the New York Times, Sony also plans to sell Paramount's TV stations and streaming service. And there's a new investigation into the door panel blowout on a Boeing 737 MAX 9 plane in early January. The SEC is scrutinizing the statements made by the company about its safety practices before and after the incident on the Alaska Airlines flight. The investigation is focused on whether comments by the company or its executives misled investors in violation of the Wall Street regulators' rules, according to 3 people with knowledge of the probe. The SEC reviews don't always lead to enforcement actions, but they can lead to fines for companies or officials. And Pershing Square founder Bill Ackman was criticized for his attacks on diversity and inclusion policies in a closed-door panel discussion at the Milken Conference in Los Angeles. Ackman has previously labeled DEI initiatives as inherently racist and illegal. At least one speaker said his comments reflected a poor understanding of the civil rights movement. In a statement issued afterwards, Ackman said he has written thousands of words about his nuanced views on this important topic, and he asked people to read them fully to understand his perspective. And that's your Bloomberg Brief, John.
Shanali, thank you. More from Shanali in about 30 minutes' time. Up next on the program is bad news, still good news.
As we sit here right now, some of the bad news is good news. At some point in time, that bad news turns to bad news. So I think the Fed will come out, cut rates, and make sure we do, again, elongate this recovery.
We'll continue that conversation in just a moment. Equity futures positive here by 1/3% on the S&P 500. Live from New York this morning. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Live from New York City, welcome to the program. Anne-Marie down in Washington. We'll catch up with AMH in just a moment. Bramo taking a long weekend. Danny Berger alongside me this morning for the next couple of hours. Equity futures on the S&P 500 positive by a third of 1%. Yields higher by, let's call it a single basis point, 446.10. As yields retreat for a second consecutive week, they climb just a little bit on the session. Under surveillance this morning is bad news, still good news.
As we had that pullback over the last, couple of weeks, that was a time to, maybe put a little bit more money to work into the equity market. But I think going forward, the risks are more balanced, as you mentioned. As we sit here right now, some of the bad news is good news. At some point in time, that bad news turns to bad news. So I think the Fed will come out, cut rates, and make sure we do, again, elongate this recovery.
So here's the latest this morning. The S&P 500 climbing to its highest level since early April as economic data supports the case for rate cuts. Anastasia Amoroso of iCapital writing this: we find more positives than negatives for the environment right now. So we would be adding to equities exposure if underweight relative to strategic allocations. Anastasia joins us now for more. Anastasia, can we start by talking about the setup going into next week with some big data points on deck, including CPI and retail sales? Can you walk us through that?
Sure. Well, good morning, John. And first of all, I want to comment on this bad news conversation going into next week. I don't actually think we have much in terms of bad news. We had slightly weaker GDP report, but if you look underneath the hood, we actually have a very strong core demand in the economy. When you look at the real-time consumer data, it's actually improving from earlier in the year. And then if you look at the manufacturing surveys, maybe they disappoint a little bit on a one-month basis, but I still look at the inventory levels, and I think they're low enough to jumpstart a restocking cycle. So I think the setup going into next week, the CPI report next week, and then NVIDIA the week after, I think the setup is fairly strong from the growth perspective. And, in terms of inflation, we were waiting for the last mile of inflation. Guess what? It's here. It's upon us. We've managed to go from 5.8% CPI a year ago to now hopefully 3.8% or below this year. So that's almost 2 percentage points of improvement. And, if you look at the core PCE metric, it's 2.8%. So that's a two handle. So I think we are in that last mile, and that's actually a positive development.
Anastasia, you sound like someone who would be very comfortable being a bull in this equity market right now. We're past 5,200. Can you keep buying?
Yes, I can. And obviously the risk reward was better when we were closer to 5,000. And that's why we were saying that we should be adding to allocations if you're underweight relative to strategic ones. But still, if I look ahead and if I look at the current multiple, which I think can be sustained as long as this economic environment is sustained, and if I apply that to $278 in S&P 500 earnings for next year, that gets me to an implied price target of 5,400 on the S&P. I think that's the base case scenario. And so I do think stocks are worth being in and worth staying for. And, maybe the upside to 5,400 is not all that great, but that's for the S&P. And I think you can find pockets of opportunity within the market that should be able to outperform.
Anastasia, it's Jim Bianco. I want to ask you about the bond market. We started the year at the 10-year yield at around 3.9%. We got as high as 4.7% a couple of weeks ago, and we're around 4.5% now. Is that uptrend going to continue, do you think, or do you think we're kind of finding a high yield for the year?
Yeah, I think, thanks for the question, Jim. And I think for now, we have sufficiently priced in the new reality, which is growth that is remaining pretty robust, which is inflation expectations that have picked up. And of course, the central bank policy, which apparently may not have much in terms of rate cuts this year. So I think, Jim, that move to 4.7, that sufficiently reflected that. And when we look at the implied fair value on a 10-year based on some of the models out there relative to where the 10-year is today, it is trading above some of those fair value models. So I do actually think that's what gives me more optimism on the equity market, is if the 10-year can pause around these current levels, then that's less drag on valuations for equities.
Do you think that the Fed is going to move this year, and would that change your outlook a lot if they were to move?
Look, I do think the Fed will likely move once, maybe twice this year. And obviously that has to be later in the year. Look, the Fed, I think, realizes that they solve what they could solve, which is slowing down demand in the interest rate sensitive parts of the economy. What the Fed cannot solve is the supply of labor and the supply of housing. And when you look at inflation today, what's really making it sticky, it's the fact that wages are still rising and the fact that there's a shortage of workers. And I'm in Miami this week, and apparently the unemployment rate in Miami is 1.9%.
Wow.
So talk about a lot of demand and lack of labor. The Fed can't really solve that. You know, the Fed can't also solve the shortage of housing and the underbuilding that we've had in the economy of housing over the last 10 years. They could slow the demand, and they have done that, but they can't quickly turn on the supply spigot. So I think having this realization is the reason why the Fed will likely cut interest rates, because they've done a lot, and certain parts of the economy, certain pockets are certainly feeling the strain, which is commercial real estate, especially in office. And of course, that relates to the regional banks as well. So I do think, you know, if inflation continues to be somewhere in the 2 to 3% range, as we move through the year, they should cut rates.
Anastasia, you've been constructive for a while. You've had a bias to buy. I remember you called the pullback in April a better entry point. Clearly, based on the last few weeks, you've been right. Could you tell us how independent your market call is from your Fed call?
It's fairly independent, Jonathan. When we wrote the outlook for this year, we did expect rate cuts, but at the same time, we said, what if the Fed doesn't cut interest rates? And the conclusion was, it is still an equity market that's worth staying in and worth being in. And the reason we said that was because of the growth resilience that we were expecting. You know, there's this notion of the U.S. exceptionalism, of the U.S. economic exceptionalism, and it is so true, because this economy is not all that interest rate sensitive. And in fact, when you look at the consumer, what we pay in terms of mortgage has not actually reset higher, because only 5% of mortgages are floating rate. And yet, the amount of income that we earn by parking the cash that we had in a money market account is quite significant. It's a significant pickup. So this is why, you know, we thought that the consumer can handle 5% interest rates as they have, supporting the economy. And that's why even if the Fed doesn't cut rates, the economic backdrop should support equity valuations and equity earnings, of course.
And so far it has. Anastasia, you've been great. It's good to catch up. Anastasia Amoroso there of iCapital on the backdrop for the Federal Reserve and this market as well. It's been a confusing one for a lot of people, Jim. Help us explain it, how we've gone from pricing in 7 cuts to 1, and this equity market has been okay.
I think when we were at 7 cuts in January, we were under the impression that we were solidly going to a soft landing with some whispers about a recession, and that we were solidly on our way on that last mile to 2%. Then, over the past 4 months, the data has really surprised to the upside. And it kind of dashed, at least initially, the recession call, then it dashed the soft landing call. And as far as the last mile for inflation, it's been pushed out. And I think that that's what happened. There was an expectation, like I said, we were going to see, if you go back to the Bloomberg consensus data, we were going to see something like a 1% GDP growth year and now we're at 2.5, and that's a big difference.
Massive difference. Jim Bianco is going to be sticking with us. Up next on the program, Israel's Benjamin Netanyahu striking a defiant tone following President Biden's pause on weapons shipments. We'll get the latest from former senior U.S. intelligence official Norman Rule, sitting down with Anne-Marie down in Washington, D.C. If you are just joining us, equities are positive by a third of 1%. We are up on the morning. We are up on the week, heading towards 3 weeks of gains on the S&P 500. Yields are a little bit higher this morning by, let's call it, almost a basis point on a 10-year at 4.46. And in the FX market, the euro doing not much at all, 107.77. To round it out, and crude for you, approaching 80 all over again, 79.87 on WTI, and positive 0.8%.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to the program. Stocks doing okay, up a third of 1% on the S&P 500. In the green across the screen on the NASDAQ as well, up by 0.4. On the Russell, up by 0.4% too. On the S&P, as you might have heard repeatedly through this program so far, headed towards 3 weeks of gains on the S&P. Longest weekly winning streak going back to February. Switch on the board and get to the bond market. 2 weeks of falling yields on a 10-year Down again this week, up on a session just a little bit by a single basis point, 446.10. And the 2-year poised to close basically where it closed last Friday, anchored at the front end without much economic data through this week, with the exception of that higher than expected jobless claims print just yesterday morning at 8:30 Eastern Time. Let's finish on foreign exchange and the challenge posed in the FX market to Japanese authorities from the Japanese yen. 155.72, positive by 0.1%. Danny Berger all over the place over the last 2 weeks.
I just think it's so remarkable to first you have the MOF coming out and saying, hey, we're going to intervene in this thing. They do intervene. They say it again. We're willing to intervene. And then you have UATA saying that, okay, perhaps it changes monetary policy. And we're at 155, John.
That's the key point. Does it change monetary policy? And do you actually have to hike to actually get the market to believe it? Because right now, I think they just think he's paying lip service to what's happening.
Oh, yeah.
Will he actually consider moving interest rates higher?
Well, look, I mean, the BOJ is literally part of the government. They are part of the government. He's had conversations with Kushida. You know, we talk about, oh, is the Fed political? I mean, the BOJ has to be political because they are part of a political arm. So in some ways, yes, they could easily hike under the influence of the government.
155.72 on dollar yen. Under surveillance this morning, a slew of Fed speak on deck. We'll hear from Bowman, Logan, Kashkari, Goolsbee and others over the next few days. Traders looking for hints on the Fed's path forward ahead of the next week CPI print, together with retail sales, PPI and jobless claims. We've got Jim Bianco with us for the next 30 minutes or so. What hasn't been said that can be said a little bit later from Fed officials?
Nothing. The problem that they're facing right now is the June 12th meeting, the probabilities are like 8% the Fed's going to move. The July 31st meeting, the problem's 30% the Fed's going to move. So the market thinks we're on hold. There's nothing they can say. We'll have to wait for data to see if it surprises in either direction that would get them to move off of their current stance.
You've nailed it. In either direction. This is what interests me. What little data it would take to reintroduce a summer rate cut conversation. How much more data would it take to reintroduce a conversation about the prospect of hikes after Powell tried to bury them last Wednesday in the news conference?
Yeah, I mean, we went on last Wednesday, we went from asking him if he's going to hike rates on Wednesday to Friday, maybe a summer cut because we had a miss in payrolls. But yeah, you know, CPI next week, if it was to miss or to beat, it could really change the narrative over the next couple of weeks. But right now, we're just kind of in that wait mode. So when Fed officials come out right now, the next meeting, June 12th, is kind of baked in the cake. So we all know that there will be a lot more data before the meeting after that.
CPI next week, together with retail sales. You'll hear from some retailers as well. Walmart and Home Depot just around the corner. TSMC, they posted a 60% jump in April sales on the back of seemingly never-ending demand for AI semiconductors and a rebound in the global smartphone industry too. It follows a 34% sales increase in March, helping the stock soar to an all-time high just last month. Danny, this sets us up, I think, for NVIDIA, May 22nd, the last big one to report.
Remember ARM the other day when everyone was like, oh, they're yeah, but they were like, oh, ARM is giving a worse forecast. Surely that means at some point the AI demand is going to peter out. Obviously not. I think it was Morgan Stanley. They had something like $300 billion was going to be the CapEx for AI spend by 2030. As we were talking about yesterday, the runway for NVIDIA, it literally looks infinite at this point.
You mentioned Peter Cheer of Academy Securities. Peter Cheer, over the weekend, coming into this week, talked about how 10% was the new 1% for tech names after earnings. What do you make of the outsized moves we've seen at the single name level over the last few weeks?
Oh, it's been extraordinary, especially because what you've seen from a market perspective is they report after the close, and then you get most of the move after the close. My mother was asking me about that. Maybe I should have you explain, how does something move after it closes, you know? But that's what's going to happen with NVIDIA. We're going to wait all day, and traders can start their day at 4 p.m., you know, Eastern at that point.
It's kind of bizarre, isn't it?
Yeah.
It's all we're going to be doing on May 22nd. Everyone's going to start work at 4 p.m. Eastern time in the afternoon. Let's turn to our next story. Israeli Prime Minister Benjamin Netanyahu vowing to press on in Gaza with or without U.S. support. The U.S. pausing an arms shipment to Israel over concerns about a possible ground invasion into Rafah. Netanyahu telling U.S. television, quote, if we have to stand alone, we will stand alone. Let's head down to D.C. and catch up with Anne-Marie, standing by with former senior U.S. intelligence official Norman Rule. Hey, Anne-Marie.
Hey, John. Good morning. Thanks so much. And we're so lucky to be joined by Norman Rule, former U.S. intelligence official, also a senior advisor at CSIS. Norm, you've joined us a lot on the course of this conflict in the past few months. Where are we now, given the fact that the Biden administration is putting some weapon deliveries on hold? Netanyahu has come out defiant, And the ceasefire agreement is very elusive, and the head of the CIA left the Middle East. Where are we in this conflict, and where is it going?
Good morning. That's the number one question the policymakers should be asking themselves, and I don't think we have a clear idea going forward. The Israelis are moving forward against Rafah, and in many ways they're doing exactly what the administration sought. They have closed the Rafah corridor for smugglers. They have opened safe areas to move about 100,000 Palestinians away, and their operations tend to be small unit operations supported in a surgical manner by air, and artillery fire. This said, it looks as if Hamas continues to survive. They were no closer to a hostage release, and we're no closer to an end to the conflict.
When it comes to the conflict and the rhetoric from this administration, on one hand, we heard we want to see the eradication of Hamas. This is from the Biden administration. At the same time, they said how Israel goes about it matters. And the State Department this week said they put proposals on the table for how Israel should go about it. But now it seems like the Biden administration is saying, Joe Biden himself, he doesn't want to see any invasion of Rafah. Can you explain where they are on what would be acceptable in terms of how Israel can go into Rafah and get to their target of ending Hamas?
Well, I think what would be acceptable is a lot of luck on the part of the Israelis, that they're able to, through intelligence, identify the location of the Hamas leadership, of hostages, and then through a surgical raid, eradicate those individuals. That's just not going to happen. This is not inconsistent with past views of the administration on conflicts, where offensive activity from Ukraine to Yemen is not something this administration puts forward routinely.
They've been putting a lot of pressure on Israel to sign up to the ceasefire agreement. There are reports that there were only minor changes to what Israel was first willing to do, and then what ended up being on the table that Hamas had agreed to. Did you view it as minor changes?
Certainly not. So let's look at what Hamas is asking. Hamas is saying first that Israel must withdraw completely at some point from Gaza, that at some point that Israel must allow individuals to return north without any exceptions, which means Hamas can return north. Hamas is saying that it wishes a large number of Palestinian prisoners released for every hostage, and that those prisoners cannot be individuals selected by Israel, but rather Hamas. So you could have the worst Palestinian terrorist under Israeli detention returning to Gaza, frankly, to do what Sinwar did after his release, and that is conduct operations against Israel. Last, the number of hostages Hamas is willing to release consistently drops. They're no longer willing to say which hostages are alive or dead. We're in a situation where it's likely that every week more hostages will be revealed to be dead.
That's devastating.
It truly is for the families involved, truly.
When you look at what's happening on the ground, and you have the fact that the administration is now withholding some of these weapons, not just is this political, but it is the fact that in Rafah, it is a very dense population, very close together, more than 1.4 million people and Palestinians. These kind of weapons, how deadly could they be if Israel was to use them?
Well, you've got two problems here. First, you have an adversary that purposely hides behind civilians. Every Iranian proxy uses a civilian as a shield.
Why hasn't the administration said that more? We've known a lot of that since 2011, where Hamas decides to set up their control centers in hospitals, in schools. The same way Jake Sullivan came out and said to the world what Putin was doing ahead of Ukraine. Why haven't we seen the administration talk more about how Hamas conducts this war?
I think Admiral Kirby would say that he has described Hamas as murderous, but there hasn't been a lot of detail. And this is the same modus operandi that the Houthis have used, that Lebanese Hezbollah uses. So if you're the Israelis, you're stuck. Do you allow Hamas to win, or do you attack an adversary that hides behind civilians? So if you're going to do the attack, you need precision weapons, you need exquisite intelligence, and the weaponry the U.S. has provided often includes kits that enable bombs to hit with the most precise capacity possible. At this point, though, I believe the Israelis have more than sufficient ordnance to conduct operations at the current pace, but over time, this would become a problem.
Where does this leave the U.S. support for Israel?
Well, I think the administration would say it continues to provide significant defensive support to Israel for the Iron Dome. It continues to provide political support when appropriate. But for a variety of reasons, to include domestic purposes, it is holding a much tougher line on the work against Rafah. But we're stuck. The adversary is hiding behind 1 million civilians. And unless this adversary is eradicated, they have promised to continue a murderous assault on Israel, repeating October 7th.
The administration also talks about what would be the day after. What does that look like? Some sort of peace agreement, not just the ceasefire deal, an actual new, potentially revamped Palestinian Authority. But how do you get to point B?
Well, there is no such thing as the day after. There is what I would call the months after, where you'll have a right-wing government in Israel that's got to be dealt with, an ineffective Palestine Authority government that's got to be dealt with, and Hamas and Iran, they get a vote, and they're going to do their darndest to upset any peace deal. And if Hamas feels it's got a capacity to survive, that probably kills the prospect of a two-state solution, simply because no Israeli can tolerate a Hamasistan on their border led by a government that is devoted to resuming attacks on Israel.
If there's no two-state solution, where does this leave Israel with the rest of the region, most notably the kingdom?
Where it is at this point. And the Saudis, the Emiratis, and others have said there must be a two-state solution, and there must be an American-led coalition to achieve this. And again, as difficult as this might be with the Mahmoud Abbas government and the Bibi Netanyahu government, it's likely impossible if you have Hamas running Gaza.
So normalization, not this year?
It's going to be a challenge, but we have some very effective diplomats on all sides, to include in Saudi Arabia and in the Emirates and elsewhere, who will do their darndest to make this happen. So you can't work the Middle East for a number of decades without being an optimist, and so I try to be an optimist on these things, but it will be difficult.
Norman Rule, thank you so much for your time this morning. John, of course, that was Norman Rule, former U.S. intelligence officer and a friend of this show, really trying to understand the context and the difficulties of what is happening on the ground right now in Gaza.
AMH, thank you. He's one of the very best. Thank you, Norman. Equity futures right now on the S&P positive by 1/3%. If you are just joining us, here's an update on some of the stories elsewhere with your Bloomberg Brief. Here's Shonali Basak. Hey, Shonali.
Hey, John. HSBC and Standard Chartered are among major UK firms pressing Prime Minister Rishi Sunak to tone down proposed restrictions on doing business with China. Sources say the banks are lobbying ministers not to include China in the strictest risk category in new national security legislation. They argue this would impede business and trigger negative publicity. And Apple has issued a rare apology for an ad touting its latest iPad. The commercial shows musical instruments and other creative tools being crushed, drawing criticism on social media for what many are calling a depiction of the destruction of humanity. The Apple Vice President of Marketing and Communications telling Ad Age, quote, "We missed the mark with this video and we're sorry." Apple says it won't air the ad on television as planned. And finally, Formula E, the electric version of the vastly popular Formula One, is now in its 10th season. And in an interview with Bloomberg, the league CEO told Bloomberg it's always open to bringing in new competitors.
Absolutely see a BYD team. I could see a Geely Group team like Lotus or Zeekr, SAIC, who obviously own brands like MG across the... So absolutely I can see a Chinese team. We actually have two Chinese teams here. We have ERT, but we also have Envision.
What about a Tesla team?
I think Tesla's unlikely, and I'll tell you why I think it's unlikely. So all of the teams here are racing on a common battery. So I'm not sure that Tesla would be so keen to run on a battery that isn't their own.
CEO Jeffrey Dodd went on to say that he would love for Tesla and Elon Musk to call, but he doesn't expect it to be on the top of the list. And that's your Bloomberg Brief, John.
Shonali, thank you. Appreciate it. Much more from Shonali again in about 30 minutes' time. Can we just pause just for a second? Why are they apologising for the second time on this show? I do not get it. Who believes, watching that, they're scared about the destruction of humanity? Where does that come from?
Who is taking this thing so literally, right? I mean, this is Apple's whole shtick. We're inventing the future, and we tell you what you want, but we're going to apologise for doing that.
Who are they apologising to?
Some angry people on Twitter,
To Jim Bianco. Jim, you offended by this?
No, I didn't understand it either. And all I kept thinking is, you're going to apologize, not run the ad. So good. Now there'll be 100 million views on YouTube for the ad.
Yeah, maybe it's an ad strategy, actually.
Sitting at home still using VHS, these people, and vinyl, sort of offended by Bizarre. Stock is higher, whatever, by 0.2%. Up next on the program, President Biden cracking down on Chinese EVs.
The Chinese double down on their what we call non-market practices. It's a kind of predatory pricing practice worldwide that has driven out producers in other economies, leaving the Chinese economy having cornered the market in production.
That conversation just around the corner. We'll catch up with Josh Wingrove on the latest effort from the White House to clamp down on Chinese EVs. From New York, this is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power.
This is Bloomberg.
Stocks on the S&P 500 positive here by 0.33%. We are about 100 minutes away from the opening bell. We're counting you down here on Bloomberg Surveillance. Yields are higher by a single basis point, 4.4649 on a US 10-year. Under surveillance this morning, President Biden cracking down on Chinese EVs.
The Chinese double down on their what we call non-market practices. It's a kind of predatory pricing practice worldwide that has driven out producers in other economies, leaving the Chinese economy having cornered the market in production. Right now, we're still 85% reliant on Chinese production and supply in solar panels. We've also seen it in batteries. We're seeing it now in EVs.
So here's the latest. President Biden set to unveil new tariffs on China next week, targeting key strategic sectors including EVs, batteries, and solar panels. The reporter behind the story, Josh Wingrove, joins us now for more. Josh, fantastic story, sir. Enjoyed the read first thing this morning. What are you and the team learning about what we might hear next week?
Well, right now we're just trying to figure out the scope of this. You know, this has been going on for some time. As you know, since 2022, they've been doing this review. And the question has kind of been, you know, how high will they ratchet it up? Will they offset it with declines in other sort of less critical sectors to try to make it a wash? It doesn't look like that's going to be the case. And so what they're reporting here is that certain key sectors will see tariffs rise, either from existing levels or, you know, from the floor, from zero, depending on what they are. Those include electric vehicles, solar cells, batteries, but potentially other things. We don't know the full list. We also don't know the levels that they're going to. On the flip side, the other existing tariffs outside of those key sectors are expected to be pretty much more or less maintained. In other words, no across-the-board offsetting decline of some of those originally Trump tariffs. And so Biden is looking to sort of go tougher on China here while also stopping short of what Trump wants, which is sort of new across the board tariff, 60% on all Chinese goods. Democrats think that would stoke inflation and pricing. They're going to steer clear of that, it seems. Instead, looking at these key sectors, of course, autos also has a pretty strong election overlay, as you know, and Biden is trying to win an election that runs through Michigan and a handful of other states. So it's hard to ignore the 2024 angle here as well.
Well, let's get into that angle just a little bit more if we can, Josh. Can you just explain to me, as far as we're aware, Chinese EVs don't exactly have a big market in America right now. So what are they addressing?
I think a wave could be coming if they don't do anything. And it's the same thing on steel and aluminum. Biden has sort of teased this announcement in Pittsburgh a few weeks ago with a call to raise tariffs on steel and aluminum, in some cases from 0 to 25%. It's a fairly big jump. And, you know, it's really tiny volumes that we see from China coming into the U.S. from both those metals. But they were expected to rise. They're worried about dumping. The U.S. has expressed concern that China will try to export or dump its way out of sluggish growth and some of the woes it's experiencing right now. And it's the same thing with EVs. There are broader concerns with EVs and connected vehicles as well around data security and what information the U.S. is comfortable handing Chinese companies. You're seeing debates about this in all sorts of sectors related to China. Of course, TikTok being top of mind is one of them. So really on both steel, aluminum, and EVs, this is a case of, you know, heading off what the U.S. expects could be a seismic shift as opposed to addressing a big part of the market today.
Well, Josh, when it comes to EVs specifically, the irony isn't lost on most people that both Europe and China have lobbied similar accusations against the U.S. China even filed something to the WTO basically saying that the subsidies that you require for your EVs are discriminatory. So knowing China's stance already on that, how are they likely to respond?
That's the multi-billion-dollar question, I suppose, right now. Some of the analysts overnight from our colleagues in Asia are saying that they aren't sure necessarily that there'll be a response immediately, that China wouldn't want to trigger sort of a full tit-for-tat trade war, at least during an election year. It does seem like some kind of response would be necessary. We've seen the Chinese government, criticizing the Americans for taking this reported step. I'm sure, of course, they're waiting to see the fine print, as we all are. So right now, I think this is the question is how far this will go. Remember, Trump, of course, had a bit of a back and forth, tariffs on American agriculture exports that hit sort of his political base. So the potential to get back to that kind of environment, of course, hangs in the air. It's just right now not clear what will happen. And if it did happen, what goods would be targeted? Would they try to target Biden's sort of political backyard, or would they target Trump's, or would they target both? It's really unclear.
Hey, Josh, great reporting, sir, as always. Bloomberg's Josh Wingrove there on the latest from the team. Josh, Jennifer Jacobs, Eric Martin, the president and the administration poised to unveil a sweeping decision on Chinese tariffs as soon as next week. Jim Bianco's with us around a table of Bianco Research. Jim, just some final thoughts. The election, is it still too early to think about some of these themes?
Yeah, I think it is a little bit too early because we still don't really know. We're still so wrapped up in personalities right now with these elections and all of these other issues and brain worms and everything else. And we're not really ready to talk about
executing dogs.
Yeah, exactly. When are we going to get to talking about policy? And when are we going to get to talking about contrasting what my administration means versus their administration? So all we're left with is kind of these generic, well, Republicans do this and Democrats do that. And that, I always feel like, is always kind of in the market anyway.
So David Kostin of Goldman would make the argument, not necessarily trade on policy, but trade on just volatility around the election. Should we get a result where Trump, for example, doesn't accept the results again, and there you get volatility, and you should be prepared for that. Should we be prepared for that?
I think so, but that's probably an October or November story. Actually, it could actually be a November to December story, more than anything else. But I don't think you're going to see that kind of volatility come into till at least the conventions at the earliest.
In many elections, it used to be a difference in degree and not kind. It just feels like there's massive differences now between administrations from one to another. Does it make it difficult to look ahead to 25? This is a conversation we started having on this program in the last week. How do you construct a view on 2025 in the American economy and in American markets without a decent understanding of what policy is going to look like from the White House?
And it's impossible to understand because, certain things get said all the time. For instance, a couple of weeks ago, the Biden administration talked about a 44% capital gains tax. And everybody got all tizzy. But we forgot None of that happens until Congress passes a law and the president signs it. He's not a monarch. And so we hear these kind of things, and then we got to remember, it's not just the president, it's also Congress and what they're willing to want to do as well.
And they've already tried to do that. I think it was Sinema out of Arizona that prevented that from happening already under a Biden administration.
Yeah, and it just shows you how difficult it is to get any of these proposals through, like Trump wanting to put himself on the Federal Reserve Board.
What did you make of that story? Can we finish there? I've heard from so many different people who've all said the same thing about that Journal story. They have yet to hear anyone from Camp Trump say it on the record. What do you make of that story?
You know, I understand his feeling. He's already publicly said he would fire Powell if he became the president, and he's already got that committee headed by Arthur Laffer that is looking at potentially who would be the next Federal Reserve chairman, and Arthur Laffer decided it probably get Arthur Laffer. Exactly. So I know that the expectation is that there will be big changes at the Federal Reserve should Trump come back. But as far as him putting himself on the Federal Reserve Board, you got to rewrite you got to rewrite the Federal Reserve Act to do it. You just don't get to just, say, I'm on the board now.
Hey, Jim. You'd be great on the board if we could make it happen. Jim Bianco of Bianco Research. Thank you, Jim. Appreciate it. Coming up in the next hour of Bloomberg Surveillance, taking you towards the weekend with Dan Suzuki of Richard Bernstein. We'll catch up with Oliver Chen of TD Cowen. Looking ahead to some of the big retailers next week. We'll hear from Walmart. We'll hear from the likes of Home Depot. And we'll talk a little luxury with him as well. Neil Dutter on the latest economic data in America. Renmax, very best on CPI and retail sales next week. And Mandeep Singh on some of the earnings from big tech. Equity futures on the S&P 500 positive here by 0.33%.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
On season 2 of The Circuit, we're walking with the titans of banking.
Hello! You guys love these meet and greet things.
Me too! And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a caricature.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money, you've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty bad.
badass. That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
Market can live with an environment where growth is strong and maybe the Fed only cuts a couple times.
What makes me question the degree of restrictiveness is really the strong activity data that we continue to see.
The Fed are very focused on that domestic labor market dynamic, and I think that will continue to be the case.
If there isn't more of that dovish pause type of language, this is a market which is a bit more vulnerable.
We're still in the early innings of seeing the data really cool in the way that the market wants it to.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now. Live from New York City this morning. Good morning, good morning. Your equity market positive by a third of 1% on the S&P 500. Let's get you into the weekend, the next 24 hours, and then we'll have a sneak peek of next week. So the next 24 hours, the market day. Need to look ahead to University of Michigan consumer sentiment numbers a little bit later this morning, and a ton of Fed speak as well. Here's your lineup for the Fed speak this morning. Bowman, Logan, Kashkari, Goolsby, Barr. You'll hear from Mester apparently a little bit later as well. And then into next week, we've got PPI on Tuesday, Wednesday CPI and retail sales. Thursday, you've got jobless claims all over again. And we'll hear from some retailers, Danny. We'll get the likes of Home Depot and Walmart.
What I'm really scared about, John, what keeps me up at night is the idea that we'll get really strong retail sales, and then Walmart will come out and say the consumer is concerned, they're feeling the pricing pinch, much like we've heard from other consumers, and then we get to the end of next week and say, I don't get it, I'm still confused.
What do you think the most toxic mix of data we could possibly get would be? An upside surprise on inflation, downside on retail sales? Would that spook people?
No, at any point, it's all toxic, right? We don't know where we are in this world. CPI is too high. We say, okay, maybe hikes need to come back into the conversation. You know what happens if it's too low. We're going to say, stagflation. Is that what it is?
James Athey of Aberdeen, I'll keep going back to what he said on this program a long time ago. Narrative table tennis. That's what he said last year. That's what it still feels like from week to week and sometimes from day to day. Equity futures on the S&P here, positive by a third of 1% on the S&P 500. These are the scores for you going into the opening bell in about 88 minutes' time. Yields are higher by 2 basis points on a 10-year, 4.47. And in the FX market, a euro going absolutely nowhere. 107.80 on euro dollar. Coming up, Dan Suzuki of Richard Bernstein as earnings optimism drives markets. Oliver Chen of TD Cowen looking ahead to results from big retailers. And Renmac's Neil Dutta weighing in on the labour market ahead of CPI next week. We begin with the big issue. Stocks seeing a boost from earnings optimism. Dan Suzuki of Richard Bernstein saying this. Looking past the near-term volatility, the market has strong support from earnings. Until you see signs that earnings growth is starting to peak, the base case should be for markets to trend higher. Dan, a good friend of this show, is with us now for more. Dan, why haven't we seen that peak already? What would you say back to that?
Well, I think because underlying growth is still really strong, Jonathan. I mean, I think we have to remember that, basically a year ago we were in a profits recession, and so things have been on the uptrend since then. And I think there's nothing in the economic data that suggests that that's peaking anytime soon. So I think that's a very strong support for markets going forward.
One thing you've said about the cycle, it's too early to position for the end of the cycle. Dan, can you build on that? What do you mean by it?
Yeah, I mean, the way I look at it, John, is that we're basically 15 years or so into this incredibly strong bull market. We've had some ups and downs in the meantime, but really it's been the same leadership and the same story. I think we're late in the cycle, in this bull market. I think we're late in the economic cycle. That has been one of the longer economic expansions outside of the pandemic. And I think that, so you want to position for that late in the economic cycle period, which simply means that the economy is tighter. So with the stronger that growth comes in, the more inflationary, that growth is going to be. And so I think you want to incorporate that into your positioning. But I don't think, to what we were talking about earlier, that we're seeing the signs of the end of cycle, that growth is peaking out, that it's rolling over. I think, you're starting to see, some signs of stress, but I think there's also a lot of signs of resilience. And listen, net worth for households is basically at all-time high.
Dan, one argument you could make that the market's getting ready for the end of cycle, something John and I were speaking with Larry Adams about earlier, is what is the current leadership? It is utilities. It is a safety sector, something that usually does outperform when slowdown is on the way. What do you make of it?
Yeah, I mean, I think that's to be expected. I mean, we're still, we went through a little bit of a pullback. And so during that pullback period, you had some, defensives that had been extremely beaten down. That was the area of safety, as volatility was picking up. At the same time, I think, when you look at the leadership, since the market, peaked a few months ago, I think that leadership has really been in the companies that have inflationary, pricing power, or they're just outright inflationary beneficiaries. And I think whether that's, some of the commodities, the commodity producers, or the commodity producing countries, those have been the more resilient parts of the market since then.
One part of this market, Dan, that's been red hot is IG right now. The issuance has been off of the charts. 53 billion sold just through Wednesday. Already that is the most since 2021. We are well on track to get a record week of issuance from these corporate markets. I mean, cuts aren't here, but it's almost like a market that is trading like we do have lower rates at this point. Dan, can that kind of action in this market continue?
Yeah, I think it can continue, because I think ultimately what that tells you is that there's a ton of liquidity out there, and I don't see that, rolling over imminently. And it also tells you that corporate profits are very strong. And again, I don't see any signs that those corporate profits are peaking out. So I think that dynamic can continue. The question is for IG investors, are you getting compensated for the amount of risk? And I would argue that you're not really. If you look at where spreads are, they're basically at the tights of the cycle. I think there's other places. If you want to be positive on liquidity and positive on corporate profits, I think there's tons of areas out there that have plenty more upside, on that same story.
Let's talk about them. You like energy, materials, you like industrials as well. You're positioning, Dan, and we've talked about it briefly, for what you call inflationary growth. Can you get into that at a time when economists are coming on this program talking about non-inflationary growth? Where's that difference come from?
Yeah, I think, there's clearly, a view. If you look at, the level of inflation, it's come down from the extreme peaks that we saw, a little over a year ago. So people are saying that that's going to continue. But I think if you just look at the data, clearly that's not continuing. I think it's been more of a normalization. And from here, the dictator of whether inflation goes higher or goes lower is going to be growth. And I think in the meantime, I think that growth is still going to be resilient. I don't see that as peaking out. And so I think that is going to be a positive for nominal growth. And so again, I think you want to own the companies that benefit from nominal growth, which is not everybody. Not everybody's going to benefit from that, because some of them are going to feel the bite of inflation on their top line and their bottom line.
Well, let's get into that too. That might be consumer discretionary. Dan, is that where you're focused? Is that where there could be some margin pressure in the quarters to come?
Yeah, I think that would be one area. I think, if you listen to the companies over the past earnings season, clearly they're feeling, a lack of pricing power, a lack of ability to price that, pass those higher prices on to the consumer. And I think, if you look at that, the customer base, the lower income consumer is getting a little bit more stretched, is struggling a little bit more. And I think that's showing up in that loss of pricing power. So I think consumer discretionary historically tends to not do well later in an economic cycle when inflation's higher, and if the Fed comes back into play or is not going to be cutting rates, is going to be hurt by that getting priced into the market as well.
Dan, why does that translate into more widespread weakness in the equity market? And even we could go so far as to say, as the economy, if the consumer has been the engine of growth and you're starting to see signs of weakness and slowdown.
Yeah, I think there's basically a huge bifurcation within the consumer. Let's just call it the bottom 20% of lower income consumers is struggling. And that's where you're seeing all the evidence and the data that's pointing to that stress and distress within that part of that segment of the consumer is picking up. But I think when you look at the other 80%, which makes up the bulk of consumer spending, those consumers are actually doing pretty well. If you look at all the measures of leverage and interest coverage and financial obligations and their net worth, all those things are actually still pretty healthy. So I think we have a runway, for some time before that really starts to roll over.
Yeah, a lot of folks have talked about that. Jane Fraser most recently talking about the K-shaped recovery. Dan, the thing that I come back to that still confuses me is if that is true and that engine of growth is still there, why aren't the cyclical small caps doing better?
Yeah, I think the cyclical small caps haven't been doing better simply because their earnings, have lagged. If you look at the relative earnings or just the absolute earnings, they've come in weaker and they've disappointed. I think the inflection point that we're seeing is that's likely changing and they're likely bottoming as we speak. And so as you look over the next 1, 2, 3, 4 quarters, you're actually going to see an extreme amount of earnings acceleration. And I think that's why it's an opportunity because, their earnings have been terrible. They've been beaten down, but now you're seeing an inflection where they may become the leadership in terms of earnings growth, but no one cares. And I think that's the big opportunity for those stocks.
Dan, I just want to end here, getting back to your idea of positioning for a late cycle. What do defaults look like in that late cycle? How do you position around the idea that there might be more as you hit the long-expected, long-awaited maturity walls?
Yeah, I think that at least in the near term, what we're seeing based on some of the stronger economic data, that defaults actually could come down from here. But clearly at some point, you're going to see those defaults pick up. I think when you look at this, default cycle relative to the economic cycle, there tends to be a bit of a lag. So I think that, the heads up that we're going to go into a bigger default cycle, you'll see that when growth starts to slow. And again, I'm just not seeing that. I think you're seeing a normalization within sort of the services side of the economy and a big acceleration pending, for the manufacturing side of the economy. Net, I think that's going to be a very, pretty strong growth environment. And so you shouldn't see in that environment, particularly with liquidity where it is, a huge spike in defaults in the near term. Eventually, we'll see that, just not anytime soon.
Hey, Dan, appreciate it. It's good to hear from you, sir. As always, Dan Suzuki there of Richard Bernstein Advisors, breaking it down for you, looking ahead to next week. Been through next week a few times. We'll keep doing that for you through the next hour on this program, looking ahead to CPI and retail sales. Not to be contrarian for the sake of being contrarian. Of course, CPI is top of the pile. But the retailers next week, Home Depot, Walmart, really, really important to try and get a clearer read, some clarity on what's happening with the consumer at a time where the likes of Mike Wilson and Morgan Stanley are preferring, say, staples over discretionary, at a time when you've heard this from McDonald's, that the consumer's becoming more discriminating, from Starbucks, Danny, that they continue to feel the impact of a more cautious consumer. Just what is going on with the likes of Home Depot, Walmart, Macy's, Target, and Lowe's?
I think for that reason, Walmart will probably be the most interesting. Dan Suzuki was talking about it right there, this idea that it is the bottom echelons of the consumer that are struggling. But the thing that confuses me is then someone like a Walmart should be theoretically benefiting from that. Someone like a McDonald's should be benefiting from that because folks are trading down. Instead, that's not what you're seeing. Instead, they're saying we're losing pricing power. Consumers aren't coming to our place anymore, and they're not buying.
Going to hear more on that story through next week. Let's get you an update on stories elsewhere. Here is your Bloomberg brief with Shonali Basak. Hey, Shonali.
Hey, John. Shares of Novavax surging in pre-market trading. The stock rising after the vaccine maker announces a $1.4 billion deal with French drug maker Sanofi. Sanofi agreed to pay $500 million upfront and spend another $700 million as the company hits development milestones. The deal positions Novavax to commercialize its COVID vaccine for use in combination with Sanofi's flu vaccine starting next year. And Target won't sell LGBTQ-themed merchandise in some of its stores during Pride Month after a backlash to dented revenue last year. The Minneapolis-based retailer plans to offer the full assortment online, according to people familiar with the matter. Target faced threats from some customers last year over its Pride merchandise in the month of June. Pubgoers in the UK are getting a little taste of U.S. culture. Some of the country's biggest pub chains are now asking guests to tip 10% or more on their bills. The shift is leading to a lot of confusion for customers, where tipping more than a few coins has never been common. The pandemic has played a role in change, with QR codes giving restaurants an easy chance to ask patrons for a little extra. And that's your Bloomberg Brief, John.
Shonali, thank you. I feel like I should say something, put something on the record, if you will. Traditionally, it is believed that the fixed salary of someone that might work in that industry would be higher in the United Kingdom than someone in the United States. And for that reason, tipping culture has never been a massive thing. You've lived both worlds, I've lived both worlds. Keep the change used to be a thing you'd say at the bar, which is like, keep 20 pence or something, 50p, whatever it might be.
I don't understand what the confusion is. I know what's going to happen. People are going to look at, do you want a tip, and go, no, thank you.
Right, and then they're going to move on.
Yeah, exactly.
Okay. I tip, just for the record. I know that people judge you when you sit in a restaurant. There's a Brit arrived, not going to get a tip, but you know.
I worked in a restaurant once. I get a Brit at my table, terrified.
You wouldn't look after them?
No. Someone else, take them on. I'm not doing
You'd pass it over to someone else.
Absolutely, 100% would. I want my tips.
Don't discriminate based on where people are from. Up next on the programme, the Morning Calls, plus looking ahead to big box earnings with TD Cowen's Oliver Chen. That conversation is just around the corner. Futures on the S&P, positive by 1/3% from New York. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that.
Don't miss Bloomberg's interview with the
Equities positive here by 1/3% on the S&P 500. Yields bleeding just a little bit higher, up 2 basis points on a 10-year. 447.08. It's time now for the morning calls. First up, KeyBank upgrading Warner Brothers Discovery to overweight. The analyst noting improved direct-to-consumer profitability and the importance of renewing NBA broadcast rights. Next up, HSBC upgrading 3M to buy. The bank expecting the company to return to growth thanks to an improving macro environment, calling 3M a, quote, quality company trading at attractive valuations. And finally, Barclays raising its price target on Victoria's Secret to 16, maintaining an underweight rating, the retailer reaffirming fiscal 24 guidance and pre-announcing first quarter results at the high end of its prior guidance range. That stock is up and up big. Meanwhile, big box earnings kicking off next week. Home Depot Tuesday, followed by Walmart on Thursday. Oliver Chen at TD Cowen joins us now for more. Oliver, let's get into that and then we can get to what you love, which is luxury, sir. Don't worry, we will get to that topic in just a moment. Let's look ahead to Home Depot and Walmart. What are you and the team looking for next week?
We're excited about Walmart. That's our pick. We're more cautious and optimistic on Target. Walmart is a needs retailer, being 60% grocery, very helpful in terms of traffic. They're also managing well through this tough time where the consumer really is looking for value, very sensitive to price. So we're excited about Walmart. In addition, Walmart as a technology company. Don't forget about digital advertising in the marketplace model, and Walmart's getting a higher household income customer. For example, you can buy Apple Macintosh on the marketplace on the website, as well as fragrances like Burberry Goddess. So the whole flywheel is working.
Let's sit on Walmart and let's talk about price and pricing power. We've heard from various executives over the last few months that maybe they're losing some and that we're starting to see some disinflation, perhaps even deflation in certain places. What do you make of that, and what would you expect to hear next week?
That is definitely happening. What we have with this new consumer is a consumer who's not necessarily very loyal and doesn't want to overpay for national brands. What consumers are doing is what we call customized moderation, value hacking, trading down to private label when they want to or need to, and trading up very selectively. So that will continue to be a big issue. The bottom line is Walmart wants everyday low prices. They want suppliers to offer low prices too, so that the consumer has more money to spend on non-food and discretionary items. That's still a work in progress in terms of the consumer. What's good about the consumer is that there's low unemployment and there's still spending power, given $670 billion on the sidelines. What's bad about the consumer is that it's still bifurcated with pressure at the middle and lower end, in part due to inflation. As we look fundamentally, inflation is getting less bad. However, consumer confidence and what the consumer feels is still fairly volatile. So mixed signals here, but pricing's a hot topic because everybody wants low prices.
Oliver, then, do you expect with some of those headwinds you're talking about for it no longer to have the K-shape, that at some point, maybe not the upper echelons who will always continue to spend, but for it not to just be the lowest end consumer that starts to get more price conscious?
Yeah, I think everybody's getting somewhat price conscious. We see this value hacking consumer, this do-it-yourself consumer. So consumers are looking for newness. Also, what we're seeing in our studies is that there's so much receptivity to private brands and private labels, such as Kirkland at Costco and others. So that trend should continue. What we do see at the higher end is the wealth effect, some confidence, and some pockets of strength in the U.S. in particular. China is something we're watching that's been very volatile as well.
Can we talk about luxury then? I know you love it, and I promise we'd talk about it. There are some luxury brands that aren't seeing that stability. They're struggling. I'm thinking more specifically about Gucci. Oliver, who's getting it right and who's getting it wrong?
Yeah, we're most excited about Louis Vuitton, given powerhouse brands such as Louis Vuitton as well as Dior. They also own Sephora, which is a wonderful beauty concept that's global. We downgraded the stock, the owner of Gucci. Gucci's a work in progress. They really have to reset this brand. So some of these issues are somewhat specific to the Gucci brand, which needs to return to classic and timelessness. It also needs to be more elevated. So in this process, it's been quite painful, and the numbers have been quite sharp. What's been happening in luxury goods is share shifts as well. So big players like Louis Vuitton offer a full range of more quiet, more loud luxury, all kinds, as well as hard luxury. And that's been working better in terms of their execution. Gucci is something we're watching. I do love the brand personally, but it's going through a lot of change. And part of that will be deleverage or losing some customers as well.
Well, whose customers are they trying to attract? Can we talk about that a little bit more? When we talk about the high end, we're talking about the high-end luxury player. We're not necessarily talking about the upper income consumer, because I don't believe the last few years with Gucci has been about the upper income consumer. I think it's been across the board, getting access to aspirational luxury names, Oliver, and I'm trying to work out who the target audience is going to be for that brand.
Yeah, it's a bit of a reset, and you're 100% right. What's happened with the Gucci brand, which had very massive growth, is it really broadened the aperture of what luxury means. It was rethinking technology and gender, and very, very exciting. But on the other side of this aspirational customer has been more under pressure. So that's something the whole industry is facing, as well as Gucci, and Gucci has a new designer as well. So in rethinking the brand, luxury is always about elevation. That's a big focus, and then timelessness and taking you back to classic items and hearkening back to a lot of the heritage of Gucci too. Somewhat specific to Gucci, but they're definitely losing share to players like Hermes, like Louis Vuitton, and others which have a real anchor on timelessness as well.
Well, with all the attention of the aspirational buyer, Oliver, it's even more remarkable that someone like Sephora, all those beauty brands, continue to do well, because you could say, people are going to trade down, go to just a convenience store, a drugstore, get their makeup there. But why is that story so enduring? Is it just, the 13-year-olds on TikTok looking at influencers, then deciding to go to Sephora to buy something?
Yeah, it's all happening. I mean, 10-year-olds too with skincare regimes. What I love about beauty is that it's an essential good. It also gets a bit blurred with health and wellness, but lots of abundant innovation in cosmetics, hair care, skincare. As we think about fragrances, our favorite idea is Coty. We also like Ulta, which in many ways is like Home Depot for women in terms of that routine. There's a ton of innovation as well as social media that fuels new processes for cosmetics. Skincare is taking care of yourself and self-care. It's been a very resilient industry because a lot of the habits that were picked up during pandemic really stuck in beauty, and beauty is a profitable growing business globally.
Oliver,
we also see...
You're going to get us in trouble. Home Depot for women. Do you want to elaborate on that a little bit more?
Well, the whole Ulta experience is really comprehensive in terms of mass plus prestige. You definitely find stuff you didn't know you needed, but you also think about replenishment and really investing in your face and body and skin. And that's a principle that men and women love, but women can be very loyal to certain categories such as hair care and skincare. And on the cosmetics front, there's a lot of newness and innovation. So we're excited about Ulta, especially on the pullback and the valuation level here. I'll be at the Women's Wear Daily Beauty CEO Summit talking about artificial intelligence meets beauty. It's a very vibrant industry.
We're looking forward to catching up with you again soon. Oliver Chen of TD Cowen. AMH wants him on. Anne-Marie writes in, I have so many questions on Home Depot for women.
I feel like I just feel like it's worth saying that Home Depot is also for women, that it's not just for men.
Are they allowed in?
Yeah, I actually went in the other day. It was a whole thing, but they're like, our policies have changed. Please, ma'am, come in.
You know who's never been to a Home Depot? TK. Can't make it happen. And we have a Home Depot
I love it.
beneath the office.
Home Depot for men, women, except if you're TK.
TK's not allowed in. Coming up next on the programme, we'll catch up with Renmax Neil Dutter, looking ahead to CPI and retail sales next Wednesday. I love that. Futures positive by a third of 1% from New York. This is Bloomberg.
our challenge Britain's next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This whole week has just felt like a drumbeat, a long drumbeat to next week. We're almost at a weekend. We're looking ahead to next week with CPI and retail sales coming on Wednesday, some retail earnings in the mix as well, and a ton of Fed speak, I'm sure, in between. Here are the scores this morning, about 1 hour away from the opening bell, positive by a third of 1% on the S&P 500. On the NASDAQ, up by a half of 1%. On a Russell, up by, let's call it, a third and change. In the bond market, 2-year, 10-year, 30-year, new levels compared to where we were a week or so ago after we got that ECI print. A hotter employment cost index, sending yields on a 2-year back through 5%. Here we are all the way back down to 483.18 on a 2-year, up about a single basis point on the day, climbing high by 3 on a 10-year to 448.26. If you switch at the board just quickly, we'll take a look at the euro, the single currency against the US dollar, just about unchanged at 107.79. We've started to see central banks make a move, cutting rates, the likes of the Riksbank, the SNB, talking about cutting rates and maybe doing so as soon as June, the Bank of England and the ECB. And you wonder how far they can go, Danny. We were talking about this yesterday. The Federal Reserve clearly doesn't dictate whether they go or not, but whether they go all the way down to, say, another 100 basis points over the next 12 months over at the ECB if the Fed's not going anywhere, that's a different question.
Well, in the words of Andrew Bailey, there is no law that means that we can't cut before the Fed. But yeah, that's when it becomes to be a problem, when you get that bigger difference. But it's interesting to look at this market. I think Michael Brown at Pepperstone put this really well, that you have the FOMC desperate to cut, the ECB committed to cutting in June, the BOE wants to go, the BOC wants to go, the SNB and Riksbank already have. This market has decided we're in it. We're in the cutting cycle. Let's go.
Will the Federal Reserve join them? Maybe they would if we get weak data. This from Citi, Andrew Honhorst. Andrew's been on top of this with Veronica Clark. The prospect of maybe sharp weakness coming in this economy. Neil Dutta of Renmark's going to have thoughts on this in just a moment. A range of labour market data has us expecting a sharp weakening of job growth in the coming months. The rise in jobless claims to 231 may be noise associated with school holidays, but it also may be the start of a trend towards weaker labour markets. More on that in just a moment. Here are your top stories under surveillance this morning. Netanyahu vowing to stand alone. The Israeli Prime Minister striking a defiant tone, saying he will continue the war in Gaza with or without US support. The comments coming after President Biden threatened to withhold US weapons if Israel continues with the ground invasion of the Gazan city of Rafah. Our next story, President Biden looking to crack down on China yet again. Bloomberg reporting that the White House is set to impose new tariffs aimed at strategic sectors, including Chinese EVs. The move coming after a review of Section 301 tariffs first imposed by the Trump administration. People familiar with the matter saying a decision could come as early as next week. And finally, more Fed speak to round out the week with Bauman, Logan, Goolsbee and Kashkari all on deck. This is Atlanta Fed President Raphael Bostic tells Reuters he believes the US economy is slowing, saying the Fed is still on track to cut this year, even if further declines in inflation only come slowly. Investors looking ahead to PPI and CPI next week. I'm pleased to say that joining us now is Neil Dutta of Renmark. Neil, I've been looking forward to this. I was reading a note of yours earlier this week. The labour market rebalancing has been achieved. Can you walk us through just how we've done that?
Well, we've job openings have come down. Job openings, remember, are a measure of excess labor demand with very little upward movement in the unemployment rate. Now, the unemployment rate has gone up, but, it does look for the time being that the Fed was kind of able to successfully, trim excess labor demand without driving up unemployment all that much. And I think what's important now, John, is that, yes, the ECI, which you mentioned earlier, did pop in the first quarter, but the underlying, sort of drivers of that data are the average hourly earnings for non-supervisory workers. And we saw in April that that's cooling. Over the last 3 months, average hourly earnings growth for non-supervisory workers are barely up 3% at an annual rate. And given the growth in productivity that we've seen, even if you assume it's like half that, so let's say 1 to 1.5% productivity, you're talking about wage growth that is broadly consistent with the Fed's underlying inflation objectives, which is why unit labor costs, I think, have been cooling. So where's the inflation coming from? I mean, that to me is the big story here is if you ask someone, why did inflation perk up in the first quarter, they can't really point to a fundamental reason for that. Is it because expectations are perking back up? No. Is it because the labor markets are reheating? No. Is it because the dollar's weakening, driving up, pushing up the prices for imported consumer goods? No, the dollar's generally been stronger all year. So you can point to things like, well, look, financial services inflation picked up and healthcare services and, motor vehicle insurance, sort of the idiosyncratic factors. I think it's important for people to kind of go to first principles here. And, this is why I think the case for weaker inflation is still quite strong.
Well, two things to unpack there. First, the view on the labour market. Let's just build on that for a little bit if we can, Neil. So this is the line from Citi and Andrew Honhorst and the team. They say evidence is building that the labour market is poised for a sharp weakening. You use the word cooling. Can you help us understand the difference between a welcome cooling in the labour market and a prospect of an unwelcome deterioration?
Well, what you want to do is look for discontinuities in the data. That's that Alan Greenspan sort of line, right? When you have a bunch of 200,000 job numbers and then all of a sudden you have a 50, then you should be worried. But if you're talking about where we are right now, I mean, I don't really see much evidence for that. You mentioned jobless claims. Even if you assume that number is legit, which it's not because it was mostly driven by one state, New York, the break-even level is still around 260,000 if you look at the separations and hires data from JOLTS. You can kind of back out what break-even initial claims are. So you're still talking about continued jobs growth, in a range of 175 to 200,000. So if you see 175 to 200,000 jobs and slowing wage growth towards let's say 3.5%, that would be cooling. If you see significantly worse than that, then you'd be worried. But jobs are something that come out of growth, right? Jobs don't necessarily go into growth. And if the economy is growing, employment will follow. And we know that the economy is growing. If you look at underlying domestic demand, I mean, it looks like it's close to 3% in the first half of the year. So I think that doesn't leave me that concerned about sort of discontinuities in the labor market.
Well, Neil, to that point, and, earnings have backed up everything you've said. We've seen huge CapEx coming from companies, too. What could possibly drive a cooling then?
Well, what could drive a cooling in the labor market? Mm-hmm. Well, I just think it's that turnover is coming down. I mean, that's really what it is. There's been a pickup in labor supply, and there's been less turnover in the job market. And so I think those things basically tell you and combine for a moderation. I mean, we're basically hitting equilibrium now in the labor market, and I think that's the bigger story. And at the same time, I mean, the economy isn't getting away from the Fed. Yes, you mentioned CapEx. CapEx could be a big driver of growth this year, but there are other areas that'll probably cool. I mean, for example, residential investment. I mean, that was a very strong area in Q1, but given the backup in rates that we've seen, it's unlikely that repeats over the next couple of quarters. And you should see some rebalancing in consumer spending, right? Because a lot of the upward movement in consumption, and we have retail sales next week, a lot of that in the last 2 months has been driven by a decline in the savings rate. It's hard to see that lasting. So I'd expect a better, sort of more balanced mix to growth going forward. So, I don't think growth is getting away from us. But, again, it's not something I'm lighting my hair on fire for. I mean, it's sort of, you're talking about 2.5% growth, steady jobs growth, and an ongoing sort of disinflation trend. Given the improvement in supply conditions.
Yeah, right. But again, your words that you're using, Neil, normalized, more balance, getting back to averages. Is that a good enough reason for the Fed to cut?
Absolutely, because ultimately they believe that they control inflation. So if inflation slows more quickly than they think over the next several months, then they should be cutting because they wouldn't want to tolerate an even higher rate of real rates. So you have to kind of recalibrate policy just to stay even.
Should versus will. What do you think they will do?
I think they will cut. They will cut. At the end of the year, we will still be talking about how much is the economy growing and how many times has the Fed been cutting. I think the case for cuts is still quite strong. I think I put it to you this way. I think they go at least once. I think 2 is a good baseline, and I think there's an option for 3 if we're right about how quickly inflation slows over the next 2 quarters.
I think there's an argument that that's basically what we're hearing from Fed officials as well, Neil. Neil, can you help me with something I'm wrestling with? And that's this supply-side story in the labour market. Tons have been said about the amount of immigration that's coming across the southern border, how that's allowed us to have this really strong payrolls growth without the corresponding pickup in wages. Neil, based on basic communication we've had over the last week or so, apparently border encounters have dropped by quite a bit. How can we sort of anticipate the data in the months to come based on that, if at all?
I mean, I think that that's sort of the immigration story is kind of a rationale that people are working back to. It's like, oh, why has the labor market cooled off a bit? Well, here's this big pickup in labor force growth. I'm not so sure that's the case. I mean, I think unit labor costs have moderated because people are getting a little bit more productive in the jobs that they're in. So we've seen a picking up of labor productivity. So I think that's a more important driver. And to your point, I mean, I'm not entirely convinced yet that this is like a big secular increase in immigration. I mean, it could just be sort of one-off dynamics related to the to the opening up of the visa approval process following the pandemic, right? So you had a lot of people that were kind of on the sidelines, then they got their visas finally approved as things reopened. And that may well slow down. So again, I mean, it's something closer to equilibrium. But I think that people are getting more productive in their roles, right? And I think that's what's important. You aren't seeing quits go up as much. And that means that people are staying in their jobs longer. And if they're staying in their jobs longer, presumably they'll get more productive in those roles.
Neil, one of the things that people use that immigration piece to say, this is an argument that Callum Pickering uses, basically to say that we are in for an inflation spike next year if we get Trump in the White House because you get more curtailed flow of immigrants. Given what you're saying, given, again, this idea of what we're seeing as normalization, it was from some of the visa processes opening up. Is that not as relevant of a fear?
Well, sure. I think worrying about inflation, with respect to the election, I think, who knows what the outcome is going to be. But I do think it's fair to say that if Trump were to win, former President Trump were to win, then there's a higher likelihood then that you have a unified government. And we know that whenever you have a new unified government coming out of the elections, they're always going to do something. It's not like they're going to get into office and say, hey, everyone, we're going to raise the retirement age and cut spending. They're going to want to do something that makes people feel good. And whether that's, I think they'll probably lead with something like that, tax cuts, spending, that'll be inflationary. So, to the extent that there's a restrictive immigration policy that comes about, it'll add to that even more.
Interesting. Neil, enjoyed this. Thank you, sir. I know you've got thoughts on Gucci. We'll do that another time. Neil Dutta of Renmac. Neil, thank you. Thank you, buddy. Equity futures right now on the S&P positive by 0.25% on the S&P 500. With your stories elsewhere, your Bloomberg Brief with Shonali Basak. Hey, Shonali.
Hey, John. The U.S. Army Corps of Engineers says it has a plan for the continued cleanup of the collapsed Francis Scott Key Bridge. Workers will place small explosives in order to clear parts of the span on the stranded container ship Dali. The demotion could begin as soon as this week so that the ship and its moved contents can be moved. The Dali struck the Francis Scott Key Bridge in the early hours of March 26, slowing down traffic in the port of Baltimore ever since. And Ford is shaking up its C-suite of executives. Sherry House is set to become CFO early next year. House had the same position previously at EV maker Lucid Motors. Current Ford CFO John Lawler will move on to become vice chair and focus on the company's expansion plan, Ford Plus. And Pershing Square founder Bill Ackman was criticized for his attacks on diversity and inclusion policies in a closed-door panel discussion at the Milken Conference in Los Angeles. Ackman has previously labeled DEI initiatives as inherently racist and illegal. One speaker at least said his comments reflected a poor understanding of the civil rights movement. In a statement issued afterwards, Ackman said he has written thousands of words about his nuanced views on the important topic, and he asked people to read them fully to understand his perspective. And that's your Bloomberg Brief, John.
Shonali, thank you. Appreciate it. Enjoy your weekend. Shonali Basak there with your Bloomberg Brief. I feel like I need to say on the record, Neil Dutta did actually have thoughts on Gucci. We just didn't have time for him to share them. It's amazing that economists can look at exactly the same economic data. There's no sort of like sneak peek at anything else. It's exactly the same economic data and have two very different views. You've got Neil talking about a welcome cooling, and you've got the prospect of an unwelcome deterioration over a city, with Andrew Hollenhorst saying this morning in the Daily over at Citigroup, watching for weakness.
You also have Lindsay Stiefel from earlier telling us probably no cuts. Torsten Slok been talking about it for a while. And then you have Alan Zettner at Morgan Stanley saying we're going to get 3 this year. It's what makes the market, John.
Without a doubt. Opposing views. Great ideas exchange, as my friend Guy Johnson likes to say. Up next on this program, AI fueling demand for chips.
We're very confident about these growth numbers. What we're seeing is people investing faster and faster into new hardware, which ends up being a good thing for us.
We'll catch up with Mandeep Singh of Bloomberg Intelligence in just a moment to count you down to the opening bell. That cash open is 45 minutes away. Here's the price action for you on equities on the S&P 500. We are positive by a third of 1%, live from a gloomy New York City. How many summer head fakes have we had over the last 2 weeks?
Too many. Depressing.
It's like hot,
honestly.
then rain, warm, then rain, grey clouds, more rain, and a little bit of heat maybe at some point of the weekend. From New York, this is Bloomberg.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Here are your scores going into the opening bell. Equity futures on the S&P 500 positive here by 0.25%. Yields look like this in the bond market, up 3 to 448.45 in foreign exchange. Not much happening. The euro just a little weaker. We're down 0.1% at 107.69. We've been light on economic data all week. We've had jobless claims. That was the wrong kind of upside surprise. At 10 a.m. Eastern time, you will get the University of Michigan consumer sentiment numbers, so look out for them a little bit later this morning. Under surveillance, AI fueling demand for chips.
Why are we so optimistic about the future? One is the business model, but because we are the CPU, the heart of everything, we have incredible visibility in terms of A, when the products are designed, when they're going to ship, what the volume looks like. So we're very confident about these growth numbers. What we're seeing is people investing faster and faster into new hardware, which ends up being a good thing for us.
Here's the latest. Chip stocks riding strong momentum as demand grows across the AI semiconductor industry. TSMC reporting sales jumping 60% in April to the tune of $7.3 billion. That follows a 34% increase in March, pushing shares near all-time highs. Mandeep Singh of Bloomberg Intelligence joined us now for more. Hey, Mandeep, it's difficult to get a clean read on this, and that seems to apply to a lot of things, including semis. Danny said it earlier this morning. ARM tells you one thing, you hear something else from someone else. Mandeep, what is the clear read and what's happening at the moment?
I mean, the clear read is the monthly numbers seem to be accelerating. And to my mind, TSMC is the best proxy for chip demand across different sectors. So clearly, they've told us, AI would be about low teens % of their overall revenue, which is a pull forward from their earlier forecast. But what this monthly number suggests is the autos and the smartphones chips demand, which was weak up until now, seem to be bottoming out. I mean, otherwise they wouldn't be reporting this kind of a bump. So to my mind, Apple guiding, that the next quarter they would see some growth indicates there will be a faster upgrade. And now we are seeing that in the TSMC monthly numbers as well.
Mandeep, I'm going to try my hardest not to talk about the iPad ad again as much as I want to. But how much of this is iPad demand? Is something different happening here? Dan Ives joined us saying he thinks it's going to be a new upgrade cycle. We've yet to see that with the iPad. Is what TSMC is telling us that indeed it's going to happen?
Well, so it's very hard to pinpoint exactly how much would flow into an iPad upgrade. But look, when I think about TSMC's revenue split, smartphone chips were the largest portion of their revenue. Now, with the pace that AI accelerators are growing, they're clearly taking away spend from non-AI server spend, and we saw that in their numbers. There was that substitution going on. In this case, I think iPhone versus iPad, I would still bet my money on iPhone upgrade being faster than iPad. But time will tell. If they come up with, a lot of new applications at WWDC, maybe it does drive a faster iPad upgrade cycle.
Well, so we know then who Apple's CapEx potentially benefits if it's a TSMC. It's not just Apple, though, Mandeep. We heard from all the tech giants talking about just ridiculous numbers of capital expenditures in the teens of billions for every single quarter, more or less. Who is that money going to benefit of the AI players?
Well, so it's interesting you mentioned, Apple's CapEx. I mean, we are getting hints that they are actually thinking about, coming up with their own chips for data centers. I mean, so far, Apple's chips were more geared towards their own devices, iPhone, iPads. Now we are talking about, Apple actually upgrading or applying their own chips in their data centers. And that would be huge for someone like TSMC, given how much business they get from Apple on the consumer handset side. And I think if Apple is another CapEx player, which they didn't indicate on the earnings call. On the earnings call, they suggested they will use more of the capacity from the cloud providers. But if they're designing their own chips for data centers, guess what? TSMC stands to benefit the most, I think, in this case.
Who stands to lose?
Well, I mean, I think what we have seen is the substitution. So clearly, AI accelerator spend has taken away the CapEx from, the CPU and the other types of hardware spend. So your Intel, I mean, the fact that Intel is, at a $125 billion market cap versus TSMC at 750 shows that, it's already reflected in the numbers and the market sentiment. But clearly, the CPU portion is the one that's getting affected the most. And I think you're seeing more bespoke accelerators. And that's why the foundry players, which can customize the chips, are doing so well.
Mandeep, Danny gave a nod to it. Let's do it. When was the last time you heard Apple apologize for anything? And for the record, I'm still not quite sure what they're apologizing for. When was the last time something like this happened at that company?
Well, I think it's hard to see, Apple putting any kind of step wrong in terms of how they do their PR. They've always been privacy focused, and from a PR perspective, I feel they do a great job. But clearly, there are things that they've tried to kind of fix when it comes to just their reputation. And I think they have the cleanest reputation when it comes to all the large tech companies.
This is what's really odd about it. I think Danny nailed it a little bit earlier. This is a company that talks about shaping the future. This is the very essence of what these technological firms are, Mandeep. They have destroyed industries, and they've been proud of it for a long time. If they're apologising for the ad, aren't they apologising for the product, Mandeep? And it just makes me wonder, what position is this company in right now? Have they lost a step? Have they lost confidence?
Well, I think clearly on the AI side, they have been behind, and there is no doubt that they are playing catch up here. But when it comes to ads or, specific things, I mean, these sort of things happen from time to time. But again, I look at Apple's history, and they've done a great job in being on the consumer side when it comes to a lot of the things, especially the privacy side of it. So this to me is just a small thing. I think on the whole, they've done a very good job in terms of their reputation.
Mandeep, appreciate the input, sir. Mandeep Singh of Bloomberg Intelligence. Bizarre story over the last couple of days after that product launch. Thank you, sir. Sneak peek next week for you. We'll deal with the data, then we'll get to the guests. Data first. Let's talk about retail sales, CPI, PPI, and jobless claims as well. Then you're going to have a ton of Fed speak, some retail earnings in the mix too, from the likes of Walmart and Home Depot. Danny, let's talk about it. What can we look forward to next week? The big one is obviously CPI. What stands out for you?
It's got to be retail. I think it's the individual retail companies that are more interesting, John, because we get kind of the real-time update of how people are feeling, how they're feeling about prices, and it often isn't matching with the macro data. If we get that mismatch again, I just don't know what the market does with that. Someone's going to choose a narrative of economic weakening. Someone's going to choose the narrative of strength.
There was a belief last week, and coming into this week, what we'd move on more, that we'd move more on weaker data than we would on stronger data, just off the back of this belief, in the bond market at least, that the Federal Reserve's not going to hike on strong data, but it would cut on weak. Does the same apply? The same rules apply going into next week, given the repricing we've seen in bonds already?
I mean, likely. I don't know. It just does feel like a market that's in no man's land, John, because this is going to be the end of earnings, right? And then it's going to be a while until we get the next Fed decision. And so all we're going to get are these little nuggets of data. And that just gives us these opportunities for volatility because we don't have anything strong to anchor us on. Nonetheless, Fed speak, you could anchor on that. No, you can't. They say the same thing over and over again.
Big week just around the corner. Coming up on Monday, here's a sneak peek of the guest lineup for you. Cameron Dawson of New Edge Wealth. We'll speak to John Riding of Green Capital, the NYSE president, Lynn Martin, and Torsten Slock of Apollo. Torsten said it for a while. He's looking for no cuts in 2024, and Torsten has some company. Looking forward to that conversation next week. Danny, thank you for this. Appreciate it. Enjoy your weekend. For all of you worldwide at home from New York City, we should have Bramham and a team, AMH, back up in New York at some point next week. Hopefully the band is back together. Live from New York City, this was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto. The people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny. We're going to count you down to the open, but pump up the volume when it comes to TSMC. Their volume of chip sales up 60%. That creates a bid to the whisper number for NVIDIA. You got it. We're going to count you down to the open right now. Stocks are bid. Good morning. Coming up in the show, futures rise, stocks close in on yet another record. The Fed's big tour continuing with Bowman and Kashkari, and the White House prepares to hit China with new tariffs. We begin with the big issue, looking ahead to the U.S. CPI.
CPI next week, if it was to miss or to beat, it could really change the narrative over the next couple of weeks. But right now, we're just kind of in that wait mode. So when Fed officials come out right now, the next meeting, June 12th, is kind of baked in the cake. So we all know that there will be a lot more data before the meeting after that.
Mike McKee is with me. We're tracking the Fed speak. I wonder, will it just be a reissuance of the San Francisco Fed from yesterday? They're all waiting for more confidence. Mike.
You like a choir that sings in harmony,
I
don't
do.
you? I do have some good news for you, Manus, and for everybody out there as well. You can take Thursday and Friday of next week off because the data really won't matter. But you got to be there on Tuesday and Wednesday because PPI on Tuesday and Jay Powell speaks on Tuesday. Wednesday, the CPI and retail sales. Now, the interesting thing about the CPI forecast is that it is supposed to go down. You can see the red lines there. That's the forecast. It went up in the last couple of months, and that worried a lot of people. If it goes down, that could reassure the Fed that we are headed in the right direction. Won't mean they will change rates immediately, but it will get them back on track and maybe change the conversation on Wall Street, in Washington, too. Then we also have PPI and retail sales, which will matter to the markets. PPI, we want to see the same thing, it going down. Retail sales expected to drop off significantly. There's an Easter seasonal in there. If that doesn't happen and we have strong retail sales, and some analysts think we will, then that would also change the narrative and put a lot of competing ideas out there. Before we get there, though, we got to get through today, Friday. There's only one number that really matters, and that's the University of Michigan, and we know sentiment is down, but what we're watching is the inflation expectations numbers. Now, the problem is everybody watches those. The Fed makes a big deal out of them, but as you can see, this is inflation the year after the Michigan numbers, and the folks after about 2010 stopped getting it right. They missed the fact that inflation was going way down, then they missed the fact that inflation was going way up. So we're not sure how much it tells us, but as long as it tells the Fed something and they care, then we're going to care, and you got to stay around. You can't head out for your weekend until after that's over at 10 o'clock.
Okay, all eyes down for that, and then we can perhaps leave for the day. Hoodwinked by the data. Mike, thank you very much. Let's continue the conversation. My guests are ready. It is Michael Purvis of Tolbacken and Bob Dole of Crossmark. Michael writes this: the upward drift in equities is likely to continue. The Fed is in a tweaking cycle, not a cutting cycle, and that means lower volatility, which by extension reduces equity market volatility. Good morning, gentlemen. Good to see you. Mr. Purvis, good morning. Bob, so we're on a 3-week rally. We've sniffed out this 5,200 level again. We're inches away from another record. Do you share the bullishness? Michael, good morning. You first.
Manus, well, part of what I'm sort of seeing here is that we've had, after several years of extraordinary volatility in economic data and, of course, and the Fed policy and all that, we're actually edging into a much sort of slower moving process here. The Fed is, I've been arguing, really is in a tweaking cycle here. We did, of course, have an important series of Fed meetings, and there's one around the corner as well. But I think what's important here is that, the big move here over the last few months has been, the 7 cuts got repriced to 1. Maybe it's now more like 2. We'll see here. But it doesn't really impact that. Whatever's coming out of the Fed is going to be much more minor adjustments at this point here, right? I think there's a more interesting story in the back end of the curve there with term premium that I think is an important discussion topic there. So far, we haven't really seen much term premium built into the whatever rise in the back end yields we've seen there. But it's important to just step back that, look, we're through the earnings season. We are through, a series of key Fed meetings and some repricing along the curve. There's not a lot of near-term catalysts here. That's why I've sort of said sell vol in May, go away, not necessarily sell equities in May there. But I think I'm expecting a lower VIX here, certainly for the near term.
Okay, write those options, take in the premium and deliver some enhancement. Bob, good morning to you. Look, whatever way you cut this up, there was a shift in gear and risk yesterday on the back of, we can debate whether it was idiosyncratic pip higher on the jobless claims. There has been a shift, and that shift has been, again, based on 2 rate cuts. 50 basis points of cuts is in of itself enough to reestablish a pro-risk stance. Or what else was it, Bob?
Well, the earnings have come through well also. I think we have to comment that those first quarter numbers have been pretty good, especially at the bottom line. Revenues a little bit more mixed. And that's my concern. The big hookup in earnings expected by the consensus in the second half, double-digit earnings growth this year, double-digit earnings growth next year, all in the backdrop of a consumer, particularly the lower end, that's showing some signs of wear and tear. So the vigor of this recovery off that mini correction has been surprising to me, and I think we'll have more turmoil as we go on.
Bob, do you think more wear and tear for the consumer? I mean, I'll throw these names at you. We've used them all week. Starbucks, Uber, Airbnb. I could go on, but there is undoubtedly some pressure on the consumer.
I agree. And if you go to the macro data, when you look at lower-end consumers, they're beginning to struggle. Are their incomes enough? The evidence that they're beginning to tap their credit cards, even some 401k rating. None of that is sustainable, so I think we have to watch that carefully. And look, I don't want to make a big deal about it, but the employment number for the monthly jobs number was a little weaker than expected. Initial unemployment claims picked up. I know there are all kinds of excuses, New York, spring break, all that good stuff, but I think we have to watch that carefully. We expect the consumer will slow some.
Yeah, we both, all three of us need to accept that there is a massive wealth gap and that wealth gap is becoming even more apparent. And I would say it's becoming even more apparent in this data and in these results. But we're not here to debate perhaps the wealth gap today. I do want to understand, Michael, from you. You talk about camping out. You've reflected on periods gone by when the Fed has camped out for a long and enduring period of time. Here we are. The market has repriced 2 rate cuts. So the rate camp, they may be packing up the tents soon. We go to June. We go to PPI and CPI next week. Then we float into June. When do you think the Fed wraps up the tents and moves out of the camping out zone on rate cuts?
Yeah, and just to clarify, what I mean by camping out in the note in the work I've been doing is really that when the Fed got to terminal, that it would just kind of stay there, and it would stay there because the inflation dynamics are so complicated in this cycle. There's so many new forces that are coming. There's so many. It's a sort of an odd mix-up of deflationary and new structural inflationary forces all colliding at once. That with that backdrop, the Fed needs as much optionality as it can, and And while the Fed is usually in motion, right, they're usually, increasing or decreasing their policy rates more than they're doing nothing. This was a period that, when we got to terminal last summer, that we would really just, it was my expectation that we would stay here for a very long period of time there. So that said, I do think that, look, could we get a cut or two? Absolutely. There, particularly if what Bob is saying, that we start seeing, some more erosion on the lower end consumer on their economic sustainability there, particularly with, still robust gasoline and food prices there. So there, but, what drives the Fed to into a proper cutting cycle? It's got to be something that is a very major economic contraction. You're going to have to see unemployment back up in the high 4s, I think. Mm-hmm. You're going to have to see, PMIs down, not in the high 40s, but in the low 40s or 30s, real economic contraction. There's no reason why this economy, if I'm even just partially right, that we're going into some sort of a newer, higher nominal GDP regime, that if we are going to do that we should be able to sustain higher positive real rates, as we have in so many cycles before. Just wasn't in the cycle we just knew in the few years leading up to COVID, there where we all got inured to very low nominal and real interest rates and this sort of low-fashion narrative. I just don't think we're normalizing back to that. I've been maintaining for some time that we're normalizing to something different than that.
Well, we've been through a heck of a lot, haven't we, in the past 10 days, from the ECI, the convulsing of the ECI, to the relief that you got from the jobs report, to a number of other sort of the economic surprises are also disappointing if you look at that. I want to just throw this at both of you. This is from Stephen Major, the most latest notes. So I want to get your perspective on the bond market. We restore our conviction. We restore a bullish conviction on U.S. Treasuries for this month's asset allocation, because valuations versus, and here's the kicker, gentlemen, versus the rest of the world. So Stephen has raised his bond target to 3.5 from 3, so there's an incremental move. But again, bullish on bonds, and this is the top line. So again, Bob, here we are. We saw my word of the week has been recalibration in rates from the start of the week to over the past 10 days. If these incremental slowdown in data continue, is that enough in itself to re-enter bonds? Bob?
Yes, in part at least. We've already seen some relief in the bond market on some of the things you just mentioned. I suspect we'll get some more of that. And if the slowdown that I think we're beginning to see in the consumer unfolds some more, yes, we will get more rally in bonds, and those rates should drop some.
Michael, I mean, we know Stephen Major is a bond bull. He's still at 3.5% for the end of the year, so he's not throwing in the towel on where we go. I think it's about timing, and it's about understanding the timing of the Fed and the slowdown, the potential slowdown, which it feels like there is a mini impact of the long variable lag. Does that build the case for you if you want to sell vol? I'm curious to know, is that all vol, or would you consider selling some bond volatility as well?
Well, look, we've had very elevated bond volatility, first through, an unbelievably aggressive high-velocity hiking cycle, which started 2 years ago, and then we had some sort of term premium-related bond volatility last summer, last fall. There, I do think, as I mentioned, that if we're going into a tweaking cycle, bond vol should fall. There's one big caveat here, and this gets back to Steve Major's question about buying the back end of the curve right now. And I think it's an under-discussed topic, but the elections are less than 6 months away right now. And I think when you consider that, while inflation has been the Biden campaign's Achilles heel, I don't see much policy being articulated out of either side that's going to aggressively say, this is how we whip inflation, right, there. I mean, people will, Trump will talk about it, right? But if anything, you see the policies that from the Trump side so far have been more incrementally inflationary than from the Biden side, tariffs and having a much more aggressive view on the immigration situation, right? So those are both marginally inflationary here. And so I think given that the term premium, which got to 45 basis points on the Fed's ACM model last October, we're at basically zero right now. Yeah. So all the increase in yields in the back end of the curve have been driven by other factors, right? Really more about Fed repricing, the repricing of the Fed's interest rate situation this year. If we start building in term premium here, and maybe that happens as we get closer to the election, and people start realizing that, what I think the real story is not what do equities do in November, but what do bonds do in November, then I think that's where I would take issue with Steve.
Well, we're going to have, Bob, let's just react to that. We're going to have a lot more discussion, I would say, from Trump, et cetera, around the Inflation Reduction Act, around the CHIPS Act, around the fiscal spend from this current administration. And as you say, Michael, it could well be more discussion around immigration. They're going to be very pressing issues as we go to the election. Bob, with that in mind, if the left tail risk of a rate hike has been perhaps closed off by Powell, maybe we need to refocus on the left tail risk, which is fiscal. And fiscal came to bite us in the proverbial in last autumn. Is that the left tail risk that takes you back to 5% on 10-year government bond yields between now and the election, or just after?
Could very well happen. I think you both pointed out how little discussion on policy we've had. I hope we have more discussion in the next 6 months, but there's a chance there's not a whole bunch more. But look, we know the fiscal situation is not tenable long term, and if that is the country, doesn't do anything about it, the bond vigilantes will come along at some point and hit us over the head. We cannot sustain this policy and expect rates to stay in the current place. And you put some tariffs on there, you put reasonable economic growth, and the path for interest rates will turn back up if we don't get economic weakness.
Yeah, we just need to get a quant model in place to do the equal and opposite of a trust moment, a Liz Truss and Kwasi Kwarteng moment in the US bond market. I know it's deep, I know it's liquid, I know it's a different market, but I'll just put it out there. From an Irishman to two Americans, good morning. Michael Purvis and Bob Dole. Thank you for joining me. Let's look under the hood of the stocks. We know that these chips are bid. Abigail Doolittle will take us through the moves. Abby.
It's not just chips that are bid. Let's take a look at the shares of Novavax. Extraordinarily bid. This stock in the pre-market up more than 100% at the pre-market highs, up more than 200%. This on the news, of course, that Sanofi is making a $1.2 billion vaccine licensing deal. They will receive $500 million upfront, $700 million if all the development, regulatory, and launch milestones are met. In addition, Sanofi is taking a 5% stake in Novavax, so very good news for those investors in that company. NVIDIA, there is one of those chips you're talking about, man, it's up 1.3%. This, of course, ahead of their earnings report and on the heels of TSMC's very strong quarter sales. Investors playing that forward to NVIDIA, but Alphabet not so much, down 1.2%. Reuters is reporting that Microsoft-backed OpenAI search feature will be launched next Monday, and of course that could create some sort of competition for Alphabet's own search feature, of course the well-known Google.
Well, certainly that NVIDIA number is going to be fill or kill on sentiment on this earnings season. Abby, thank you very much. Coming up, Biden said to unveil new tariffs on China.
The reality is, given the prices of the Chinese EVs and what I've seen firsthand, it will be very tough from a competition perspective. Retaliatory definitely could happen. This Game of Thrones continues to play out.
We'll talk about the impact next on Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's
an incredibly fun job for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
The retaliatory is the last thing that you need from a Tesla perspective. And I think this is something everyone's been waiting for, because the reality is, given the prices of the Chinese EVs and what I've seen firsthand, it will be very tough from a competition perspective. Retaliatory definitely could happen. This Game of Thrones continues to play out.
Great analysis there. Game of Thrones. Well, the Biden administration is set to unveil exactly what are the new tariffs on China. That will come as soon as next week. The reports say that tariffs will target EVs, batteries, and other metals. They will not be across-the-board hikes sought by the former President Donald Trump. Joining me now is Bloomberg's David Welch. David, good to see you this morning. So, look, this is as much a political message as it is an economic protective message for Team USA. What is the threat to the U.S. auto industry?
Chinese have a huge advantage in developing the supply chain and battery technology, and all that leads to lower priced EVs that they sell in China. And they're also selling them pretty successfully right now in South America. They're selling more vehicles in Mexico. So in a way, they're already on the doorstep of the United States. And if they were to sell those vehicles here, it's just a huge threat to what General Motors and Ford are trying to do. They're trying to build their EV businesses. It's also a threat to Tesla. That's a lot of jobs here. And also think about the Toyota, Honda, Hyundai plants, Nissan plants in the U.S., the Mercedes and BMW plants here. Any vehicles exported here from China threaten those jobs, and that's an awful lot of jobs in the auto sector, plus the parts beyond that. So this is a message to union voters, to non-union blue-collar voters, that the Biden administration is looking out for them and looking out for their jobs. And also it is, look, it's trying to buy time for the U.S. automakers and even Tesla to keep building up their EV businesses and lowering costs, hence lowering their vehicle prices, so they can remain competitive for the day when Chinese vehicles do get here. And I think one day they will. But we've got to get, in this country, a supply chain that can lower costs of EVs to even try to be competitive with them. And the way to forestall their advantage and put off the day that they come here is through some pretty heavy tariffs. And I think that's what they're trying to do.
Yeah, well, I mean, look at Tesla's competition landscape in China already. It's slipping behind. It's having to cut prices there. Can we talk a little bit about Tesla? Because I'd like some clarity. I'd like some help. Last week, we saw the supercharger infrastructure and the people involved in that being shelved. And yet, overnight, we hear Elon Musk talking about wanting to put another $500 million into superchargers. And then I have BP speculated to be on the verge of looking at the supercharger infrastructure of Tesla. This is the tweet from Elon. Tesla will spend over $500 million expanding our supercharger network to create thousands of new chargers this year. So can you just clarify for me where we are?
Elon Musk is always really clear until the next day when he says the opposite of what he said previously. So look, I think part of the reason he may have cut some of those people is maybe the targets to expand previously weren't being hit. But look, Tesla needs to keep expanding their charger network, especially if they're going to share it with General Motors, with Ford, Toyota, and the others who've signed on to their charging standard, because their own customers, the company's own customers, are having a hard time getting access to their chargers. A lot of them, particularly in California, are very crowded right now, and people are having to wait. That's customer dissatisfaction. So if he wants to grow sales, if he wants to keep his customers happy, and if he wants to share this network and make a little bit of money off of it by letting other vehicle owners use it, they need more charging. And you're seeing the other automakers too. They have money out there to expand their charging network with Tesla's standard. So look, everybody needs to build this out, and Elon Musk knows that.
David, thank you so much. David Welsh on the very latest with Tesla and EV. Coming up, we'll take you through your morning calls. A little bit later on, David Lefkowitz joins me to weigh in on this equity market rally. Approaching the third week of gains, we can smell the record highs.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Morning calls for you this Friday. HSBC upgrades 3M to a buy, expecting shares to benefit from improving macro environment. Next up, KeyBank upgrades Warner Brothers to overweight, seeing an upside from its direct-to-consumer business. And finally, Stifel downgrades Planet Fitness to hold, predicting a volatile few months of sales. Coming up in the show, David Lefkowitz joins me from UBS. We'll talk all things markets and this three-week rally on Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Good morning from our world headquarters in New York. I'm Menace Crenny.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
Bid me up. These chips are on fire. TSMC is up as their sales rise by 60%. That sends a nice tone warning for NVIDIA next week. Owned by Geely, this is a Chinese car maker listing on the NYSE. The stocks are bid. We're at a 3-week rush higher on this equity market. We're 1% off those record highs. Will it endure? And in many ways, that is going to come down to what happens in the bond market. You're looking at a very, very flat bond market at the moment. You've got Stephen Major greasing the wheels of research, as he says. They've shifted their timing on rate cuts from the Fed. 3.5% is still the forecast by the end of the year. So there's miles to go. Still a bull from Stephen Major. The oil market is also bid up this morning, up 0.6%. 1%. Goldman Sachs expect a extension to the OPEC Plus cuts. Middle East tensions, they're still there, but perhaps not as furious as they were. 107.77 is where we are on euro dollar. And again, that divergence trade is very prescient. The euro is holding up, even though people think you're going to get 3 cuts from the ECB versus 2 cuts in the Fed. There's one stock to watch at the open. A splendid performance from Novavax. The share is more than doubling after the company signed $1.2 billion licensing deal. Let's get the details. Abigail Doolittle.
This is super interesting, Manus, because not only is the stock absolutely soaring, it is the best day on record, not surprisingly, going back to when the company IPO'd back in 1995. And probably a lot of this has to do with a bearish short interest of 34%, because this deal essentially takes away some of the going concern that there was for operations that the company announced last year. Now, if we take it back to the pandemic, this company has developed a COVID vaccine, but they were late to the market, so essentially missed out on it. During the pandemic, it was a $200 stock. Even after doubling today, it's nearly a $10 stock. So clearly it has shrunk in a big way. So this deal with Sanofi really gives investors and the company a lifeline, that $1.2 billion deal. They will receive $500 million in upfront payments, along with $700 million if all of the development, regulatory, and launch milestones are met. In addition, Sanofi will basically have a 5% stake in Novavax. Not that that means that they'll be taking over anytime soon, but perhaps puts a few footsteps on the path in that direction. Investors really liking this news right now, up 120%. But again, I think a lot of it has to do with the short squeeze as those bears get squeezed out of the shares of Novavax.
It's pretty stunning, though, isn't it? Okay, Abby, thank you very much. We'll see you before the end of the show on Sector Watch. Autos in focus as well. Elon Musk, we've been talking about this, touting plans to expand Tesla's supercharger network. This just a week after firing almost all the employees who ran that division. Alex Semenova no easy task. We'll discuss what this means.
Yeah, it's not, Manus. I mean, quite the about face by Elon Musk here, just 1 week after he shocked both customers and other car makers by dismissing all the 500 employees who ran that supercharger network business. He's now saying that Tesla will spend $500 million on that business in a post on X. The head of BP the head of BP's electric vehicle charging business actually told Bloomberg this week that they were eager to step in and work with any real estate partners that Tesla had abandoned when they made that announcement last week. And it wouldn't be the first time that Elon Musk has done such a turnabout. Back in 2019. If you remember, he did abruptly announce that Tesla would close almost all of its physical stores and move most of its sales online. And then just 10 days later, after landlords refused to break some of the leases with Tesla, he backtracked and he raised the prices on Tesla vehicles. So very in character for Elon Musk. Shares are slightly higher this morning, with the stock was down, of course, about 31% year to date through yesterday's close. But since closing at a 15-month low on April 22nd, the stock has actually run up more than 20% as investors cheered Tesla's earnings. Another source of support for shares today is, of course, the Biden administration planning to implement new tariffs on electric vehicles from China. If Tesla closes higher today, that will be the first gain in 4 sessions. Manus.
Okay, all eyes down for that. Alex, thank you very much. Let's get back to the earnings. Akamai falling to its lowest level since July after posting disappointing results. Alex Webb can explain what they do and what went wrong.
Yeah, Akamai is very much in the business of getting content to your computer or to your smart TV. If you're downloading a game on your Xbox, if you're watching something on Netflix, there's a very good chance that it is being served to you through an Akamai network. And it's that content delivery network that is actually underperforming. It has been in long-term decline. The pace of that decline is a lot faster than the market had expected. The reasons for that, of course, are that more of the streamers are building their own networks. That's a way to reduce their costs. The increase in advertising on services such as Amazon Prime and, of course, Netflix itself means there's a little bit less audience for these things. That is meaning that the CDN business is slowing down. The other businesses, which it's trying to grow to compensate for it, namely security and compute, are actually doing pretty well. But the EPS forecast for the second quarter was between $1.51 and $1.56. The market was looking for $1.63, and that's why we're seeing a big drop in the shares today.
Well, there's certainly a brutal reaction there. Alex, thank you very much. All in context. More earnings. Yelp missing the estimates after the macro headwinds for the restaurants and growing competition from delivery platforms. Jess Menton has the latest. Talk me through it, Jess.
Good morning, Manus. Looking at Yelp, this is another read if you want to see how the consumer is doing. So this is a story where if you look at this stock, actually paired some of its steeper losses in pre-market trading, but it is still down a little bit more than 1%, so on pace for its worst day. In just about 2 days, that stock's down about 17% year to date. But what happened was it actually beat on those profit expectations for the first quarter. Actually, a lot of that was really due to its home services category. But when you look at more what's happening with the environment for restaurants as well as retailers, that's where the strength was weakening there. And so what forced the company to happen was it had to, unfortunately, pull back some of those expectations for the current quarter. And we've seen that time and time again this earnings season as companies have disappointed at times when you're looking at EPS and sales. So if you're looking at this for the current second quarter period, Yelp is projecting revenue between $350 million and $355 million. If you look at the consensus calls, however, it was for $358 million in revenue. So that's where that was missing for the current quarter. Another function that I like to use in the terminal, though, is looking at BI Go. You can look at the guidance tab. Gina Martin's team over at Bloomberg Intelligence has this. So if you look at the median performance for companies that have missed on EPS and sales guidance so far for this quarter, it's actually punishing shares close to about 7% in excess of the broader S&P 500. So that's actually the worst going back to right before COVID based on the BI data history, though. But when you're looking at the executives at Yelp, a lot of this they've pointed to when it comes to issues trying to pay for wages and things like that, and also how that pressures those costs when it comes to advertising. So that's why you are seeing that stock under a bit of pressure here. year ahead. And looking right after the opening bell, Manus.
Jess, thank you very much for the wrap up there. Well, stocks are rallying, as we've been saying. We've got earnings optimism and pockets of disappointment. The data supports the case for interest rate cuts. That's certainly building. Joining me now is David Lefkowitz. He is head of U.S. equities at UBS. You know, David, there's a great suspicion in me, call me old-fashioned, whenever the momentum just shifts so dramatically, 2 rate cuts, and suddenly we're talking about new record highs, 1% away, bonds are on fire. Are you a buyer of the exuberance? Good morning.
Good morning, Manus. Yeah, look, I would say in terms of U.S. equities, yeah, I think the backdrop remains pretty constructive, right? We've got a pretty good combination of durable economic growth, and that's now translating into improving earnings growth, and I think importantly, kind of a broadening out of earnings growth. And that's, you know, it's broadening out beyond just the Magnificent Seven. That's, I think, a clear message we're getting from the earnings season. And, you know, you guys were just talking about this, Manus, but the guidance has actually been pretty healthy. So the momentum we're seeing in the first quarter continues into the second. And then, you know, combine this good growth with, you know, here we get into the inflation question. You know, we've had some hotter inflation prints in the first quarter, but our view is that those are going to be temporary, and we're going to see the disinflation trends reassert themselves. So we think we're on pace for 2 Fed rate cuts this year. I would also stress, though, the bull case or the further upside in equities is not so much predicated on whether or not the Fed cuts 1, 2, 3, 4 times. I think the fact that they won't be hiking, that seems pretty unlikely. And in combination with the good earnings backdrop, that's really the constructive environment that we see.
Does that earnings outlook, and I know that you've got a 9% earnings growth for the full year this year, is that enough to get us to 5,500, which I know is your most bullish case? 5,200, we're at the money, we're at your target right now. And we will dance around this by a couple of hundred points. But can you tell me what takes me to 55, double nickel for the year?
Double nickel, I like that. I would say, there's a couple things. I mean, if the inflation comes in even better than what we're thinking, which is certainly a possibility, and that opens the door to even further Fed rate cuts, just better access to capital, things like that, which should spur some further sort of real growth in the economy. Also just, obviously AI has been a huge tailwind for this market. We're pretty constructive on AI. But if we continue to see, earnings expectations continue to ratchet even higher on that could be an upside case. So I think it's just a combination of, more of what the base case is based on, which is good growth and improving inflation.
And by the way, jobs are plentiful, wages are grand, unemployment is sub 4% and continues to remain there. Maybe yesterday was an anomaly. Let's pick up on the AI theme. Dan Ives was with us a little bit earlier on this morning. He's produced a couple of notes, and this is what he's saying about the AI theme. The eye-popping CapEx numbers have kicked off this software and cloud phase of AI, tidal wave of generative AI use cases. They're exploding across the enterprise world. We believe the next phase in AI spending is now on the doorstep. I mean, it's amazing. I was at the Sell Side Forum yesterday here moderating, and it sort of blows your mind when you hear people talking about technology and the speed with which AI is literally changing. Can you take that narrative and explore for me how you invest around that, or how you're talking to clients about how to be deft in AI?
Yeah, so our recommendations in terms of AI is focusing on some of where the bottlenecks are, right? I mean, I think there's, it's clear that some of the semiconductors made by some of the leading manufacturers, those are in short supply when it comes to running these AI workloads. But there's also bottlenecks, sort of across the supply chain, whether you look at the needs in the data center, look at power needs, electrical equipment. And also, we also think it makes sense to have exposure to some of the companies that could be developing some of the applications that are really going to monetize this technology. So I do think it's broader than just looking at semiconductors and really even software, and looking at where are the bottlenecks to build out the infrastructure in order to support the AI applications. Down the road, it's going to be, the applications usually are the winners. Whenever you see these technology transformations or these platform shifts, it's a little bit early to be betting on who those winners will be, but we think you need it makes sense to have a diversified basket of some of those application, those folks that are in the horse race, so to speak.
Yeah, it's good to have a runner and a rider in the race. David, thank you very much for being with us. Closing off, let's see if we can get through that extra 1% today. Maybe not on the S&P 500. David Lefkowitz of UBS on the markets. Coming up, Netanyahu vows to fight alone.
I've known Joe Biden for many years, 40 years and more. We often had our agreements, but we've had our disagreements. We've been able to overcome them. If Israel has to stand alone, we'll stand alone.
That conversation in context ahead on Bloomberg.
On season 2 of The Circuit, we're walking with the titans of banking.
Hello! You guys love these meet and greet things.
Yes, we do! And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a caricature.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money, you've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty badass. That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg. Top experts. Great questions.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
I've known Joe Biden for many years, 40 years and more. We often had our agreements, but we've had our disagreements. We've been able to overcome them. I hope we can overcome them now, but we will do what we have to do to protect our country. If Israel has to stand alone, we'll stand alone.
Pretty tough words there from the Israeli Prime Minister Benjamin Netanyahu, standing up to the narrative from President Biden on the war in Gaza. This is after Biden warns of a suspension of additional weapon shipments if Israel attacks Rafah. Amory Hordern is in Washington for us. Give me a sense of the conversations that you've had, Amory, over the past 24 hours about the differences. Is there a chasm? Is this political theater between two sides, Bibi versus Biden?
I think you can see there is, whether it's in public or behind the scenes, there's growing divide and division between Benjamin Netanyahu, the Prime Minister of Israel, and the Biden administration. And that was very clear this week when Biden talked about the pause in some of these bombs that were going to Israel. And he pretty much said he doesn't want to see an Israeli incursion into Rafah. This is very different than what we've heard from the administration in the past, which is that they had put proposals on the table for how almost what would be more acceptable to them on how Israel could go into Rafah to finish going after the remaining Hamas battalions. This sounds like Biden does not want to see any incursion, not even one of the proposals he put on the table. That's the public messaging. So you could see this growing divide. And then, of course, we get this punchy interview with Benjamin Netanyahu with Dr. Phil. And he says, if we have to stand alone, we will stand alone. One thing to note, though, Admiral Kirby yesterday, Manus, did say this is still just a pause when it comes to the weapons. But that growing divide continues. And we're also going to get, according to Axios, this report that we've been waiting on from the State Department, from Secretary Blinken on Israel. And he expected to submit it to Congress as soon as today, according to Axios. And Axios is calling it a highly critical report about Israel's conduct in Gaza.
It's interesting that Netanyahu goes on to talk about the madness of the pro-Palestinian rallies here in the United States of America and talking about the sorry state of higher education. So certainly he had a chip at Biden on that. Amri, take this forward. For now, we don't know the scale of the delay in the weapons. Rafah, over the weekend, we don't know what the situation is. What is the situation on the ground in terms of that million people trapped in Rafah? Have they begun to disperse to other areas? Where can they go?
Well, that's a great question, and that's also part of the concern, not just the domestic implications on the Biden administration. You know, you talk about what Netanyahu had to say about the protests. Axios also reporting that the Biden campaign has been getting calls and messages from some top donors that are concerned about potentially the shift in policy towards Israel. When it comes to the civilians on the ground in Rafah, the UN says some civilians have left. The issue is they would have to then go to the north, where already a lot of some of their homes are not in place. And this is why the Biden administration, beyond the domestic policy concerns leading up to the U.S. election, the issue they have as well is how densely populated Rafah is and how this is where more than 1 million people took refuge, and now they're asking them to once move again. That is their concern about what the impact could mean and the detrimental, devastating potential casualties we could continue to see in Rafah, which is why they say they're putting these bombs on hold.
It's the very essence of the argument as to why they have paused. Amory, thank you very much. Amory Hordern in Washington. Over to banking, let's take a chat about this. UBS is considering a reward system for investment bankers who refer clients, wealthy clients that is, to wealth management. The bank is looking to expand its invested assets and narrow the gap with, you got it, Morgan Stanley's Sally Bakewell is with me now. Sally, what exactly is driving these potential measures? I mean, there's a lovely line in this story. It's slightly more Credit Suisse-esque than it is UBS-esque.
Yes, that's right. I mean, these potential referral fees for investment bankers who attract new money to the lender's private banking unit are something that UBS has not done before. But it is something that Credit Suisse, under wealth management head Iqbal Khan, has tried as it sought to kind of foster closer ties between its wealth management and its investment banking units to help boost revenues. So here, this move, which remains under discussion, it shows how Chief Executive Officer Sergio Armotti, who has made catching up with Wall Street rivals on their own turf a key part of his strategy. He's relying on the newly enlarged investment bank following its rescue takeover of Credit Suisse to help bring more global products and services to US clients.
Okay, Sally, thank you very much. Certainly part of this story is about Iqbal Khan. Many have discussed his desire to drive leverage, but of course there were certain instances at Credit Suisse that came back to bite them. Bill Huang Lex Greensill, to name but a few. Sally, thank you very much. Coming up, sector price action for you as we close out this Friday with Abigail Doolittle.
So we're looking at an update for the S&P 500 today, a second update in a row, up 0.4%. Tech leading the way, up 1%. NVIDIA, a big player there, along with Broadcom, Microsoft, AMD. So a lot of those chip makers and names that you've been talking about, Manus. To the downside, communication services down about 0.3%. Alphabet, a bit of a drag. Most of the other sectors, though, sort of in between, but more to the upside supporting the gain. In fact, speaking of gains, we're up for a third week in a row for the S&P 500, the first time that we have seen that since February of this year. Interestingly, this week, all 11 S&P 500 sectors are higher. The top sector, though, utilities, up 4.2%. This is a defensive sector. Yields are higher, too. Typically, you're not going to have this sector climb with yields going higher. Some may see this as a signal that some investors are getting defensive and that there could be some sort of a pullback for stocks ahead. We don't know that that's going to happen, but that is one possible signal. And then, not surprisingly, financials are higher with yields up. We also have materials and industrials in the top 4 on the week.
It certainly is a solid week for stocks. Abby, thank you very much. Coming up in the show, market moving events to put in your diary right here on Bloomberg.
This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
To understand the bullish narrative in equities, 1, 2, 3. You have Taiwan Semiconductor sales up 60% in the month of April. That bids up the whisper number for NVIDIA, because this is going to quite literally be the definition of sentiment around AI. And that can fill or kill the overall trajectory for the back end of the year. AMD, we just put it in to balance out the 3, but I'm being unfair. Stocks are bid across the chips. Roll it over. You're 1% away from another record high. How can you not want to be on board with risk if you believe 2 rate cuts come along and this soft landing? Or have we hit peak no landing? You need to debate that. Stocks are bid. This is how your diary looks for the rest of the day. This is UMich sentiment coming up at the top of the hour. Fed speak, more of it. You can't get enough. Logan, Kashkari, Goolsby, Barr throughout the day. Next week, it is about the retailers. Home Depot will tell you their numbers on Tuesday, PPI, and then CPI and retail sales on Wednesday. That's Countdown to the Open from New York. Good morning.
decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company. But I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the praise to maximize people's ability, people's talent, and people's passion, right? Our employees should. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do. That's the best way to maximize the people's ability.
Follow your passion.
That's right.
So when you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been in this company for 60 years.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
We are 30 minutes into the U.S. trading day on this Friday, May 10th. Here are the top stories we're following. Novavax surges after a $1.2 billion licensing agreement that includes commercializing a combined COVID-19 and flu shot. That's a time when, of course, COVID-19 uptake is falling off. We'll discuss. Meanwhile, pipelines are pumping. We'll speak to OnBridge CEO Greg about the oil pipeline business and demand from data centers following the company's earnings report this morning. ETF Friday, it's best day of the week. Eric Bell is here to chat about what revival in U.S. nuclear energy might mean for your uranium ETFs. I'm Katie Redfield in New York. Welcome to Bloomberg Markets. It's on this beautiful Friday. You look at the board behind me. There is a lot of on the screen right now. S&P 500 high by about 0.4%. Of course, we are on track for a straight week gains. It feels a while since we've seen that. It's the same thing too. If you take a look at big tech, NASDAQ 100 currently higher by about 0.6%. Your leader right now is the semiconductor industry. You have the Philadelphia Semiconductor Index, the stocks up about 1% on